Picture an insurance policy, its parchment thick and cream-coloured, the edges softened by time. The document rests on a wooden desk in a London office, 1750 perhaps, or 1760. Someone has written the terms in the elaborate script, each letter formed with care. The ink has faded to brown, but the words remain legible. A promise, a contract, an agreement about the future. At the bottom, a wax seal pressed into crimson, the imprint of some merchant house or underwriting syndicate, their mark guaranteeing that if certain events occur, payment will be made. If a ship sinks, if a warehouse burns, if death comes unexpectedly, the promise will be kept. Tonight we will follow how this promise came to exist, how humans learned, slowly and patiently across centuries, to face uncertainty together. How fear of loss became manageable through arithmetic and agreement. How risk, which once destroyed individual merchants and families, became something that could be shared, calculated, spread across many shoulders until no single person had to bear the full weight alone. There is no need to remember the dates or the names of companies or the exact premium rates. Let them drift like smoke dispersing. Rest easy. We are simply going to trace how insurance emerged, how it grew, how it became woven into the fabric of modern life. The story will unfold at its own gentle pace, patient as the accumulation of premiums, steady as the payment of claims across decades and centuries. The Mediterranean Sea, 2,400 years ago. The water moves in patterns sailors have learned to read, where winds blow reliably, where currents run strong, where storms gather in certain seasons. A merchant in Athens or Corinth or Rhodes faces a problem that has no perfect solution. He owns a ship, or perhaps shares ownership with partners. The vessel is his livelihood, his capital, the tool through which he earns his living. He fills the hold with cargo, olive oil in massive clay amphorae, wine, grain, cloth, whatever goods he believes will sell well in the destination port. The cargo represents his savings, perhaps years of accumulated profit, everything he has managed to gather. The voyage from Athens to Alexandria might take 2 weeks if winds are favourable. 3 weeks is more common, a month if conditions turn poor. During that time, the ship faces countless risks. Storms appear suddenly in the Mediterranean, winds shifting from calm to violent in hours. Waves can swamp a vessel or drive it onto rocks. Pirates wait near certain islands, watching for vulnerable ships. Navigational errors send vessels off course into dangerous waters. Equipment fails. A mast cracks, rigging parts. The hull develops leaks that no amount of bailing can manage. Any of these events means total loss. The ship sinks or burns or is captured. The cargo goes to the bottom of the sea or into pirates' hands. The merchant's capital disappears. Years of work. Gone. His ability to continue trading. Destroyed. His family's security. Vanished. This is the fundamental problem. The merchant cannot avoid risk entirely. Trading requires sending goods across water. The profits from successful voyages justify the attempt, but a single disaster can erase everything, can reduce a prosperous merchant to poverty overnight, can end his commercial life completely. How do you continue operating when one stroke of bad fortune means ruin? The Greeks and Romans developed an elegant solution, though calling it insurance would be anachronistic. They called it bottomry, from the ship's bottom, the hull itself. The arrangement worked like this. A merchant needing capital to fund a voyage would approach a lender. The lender would provide money, perhaps 2,000 drachmae, perhaps 5,000, whatever the merchant needed to purchase cargo and provision the ship. But this was not an ordinary loan. The terms were different, special, designed specifically for maritime trade. The merchant agreed to repay the loan with interest, but only if the ship completed the voyage successfully. If the ship arrived safely at its destination, if the cargo was unloaded and sold, then the merchant would repay the original sum plus interest that might be 20% or 30% or even higher, depending on the route and season. But if the ship sank, if it was captured, if the cargo was lost, the merchant owed nothing. The loan was forgiven entirely. The loss fell on the lender, not on the merchant. Think about what this arrangement accomplished. The merchant could undertake the voyage without risking total ruin. If disaster struck, he lost the cargo and perhaps the ship, but he did not sink into debt. He could survive to trade another season, could rebuild gradually, could continue his commercial life. The risk of the voyage was transferred from the merchant to the lender. The lender, for his part, accepted this risk in exchange for the substantial interest payment. If he made 10 such loans and 9 ships returned safely while one was lost, he would still profit. The interest from the 9 successful voyages would more than cover the loss of the loan on the failed voyage, leaving him with a net gain. This is risk pooling in its simplest form. The lender is effectively spreading his capital across multiple voyages. Each loan represents a fraction of his total funds. A single loss hurts but does not destroy him. As long as most ships return safely, as long as the disasters remain random and relatively rare, the system works. The interest rate is set high enough to compensate for the expected losses while still leaving profit. The interest rates varied by route and by season. A voyage from Athens to a nearby port in calm summer weather might carry interest of 12 or 15%. The route was short, the weather predictable, the risks relatively low. A voyage from Rome to Carthage in winter, across open water in storm season, might carry interest of 30% or even higher. The lender demanded greater compensation for the greater risk. The Romans called these arrangements Venus Nauticum, maritime loans. The practice was common enough that it appears in legal codes, in commercial correspondence, in the routine records of Roman trade. This was not innovation on the margins. This was standard business practice, the way Mediterranean commerce functioned, the solution merchants had found to the problem of maritime risk. But notice what this system was not. It was not insurance in the modern sense. The lender was not purely spreading risk. He was also providing capital. The transaction combined lending with risk transfer, mixing 2 functions that would later separate. The merchant who received a bottomry loan might not even own the ship. He might be borrowing both the money and the risk coverage in a single arrangement. And the lenders were not specialists in risk. They were merchants themselves, people with capital to deploy, seeking return on their funds. They assessed risk based on experience and intuition, not on mathematical calculation. The interest rate was negotiated, not calculated from tables or formulas. The entire practice remained informal, personal, a matter of handshake agreements and personal trust. Still, the core insight was there. Risk that destroys an individual merchant can be absorbed by a lender who spreads his capital across many merchants. The many can support the few who suffer loss. The predictability that emerges from large numbers, most ships return, most voyages succeed, allows the system to function. This is insurance's foundation, present but not yet fully developed. the seed from which the whole structure would eventually grow. The Romans also developed mutual aid societies called collegia. These were not insurance companies in any modern sense, but they performed similar functions within their limited scope. A collegium might be organised by workers in a particular trade, bakers or shipwrights or shopkeepers, or by people living in a particular neighbourhood. Members paid regular dues, perhaps a few denarii each month. The accumulated funds were held collectively and used to provide benefits when members faced certain events. Death was the primary concern. A collegium would pay for a member's funeral, ensuring a proper burial even if the family could not afford it. In Roman culture, proper burial mattered enormously. The fear of dying unmourned, unburied, scattered rather than laid to rest with dignity, haunted people. The collegium offered protection against this fear. Some collegia also provided support for widows and orphans, paying a small pension to the family of a deceased member for a period of months or years. The amounts were modest, enough for basic survival, not for comfort, but they meant the difference between destitution and subsistence for families who had lost their breadwinner. The economic logic was simple. If a collegium had 200 members and each paid 5 denarii monthly, the collective fund received 1,000 denarii per month. In a typical year, perhaps 4 or 5 members would die. Funeral costs might run 25 denarii per burial. Widow support might cost another 100 denarii per family over the course of a year. The total annual costs might be 300 to 400 denarii. The income was 12,000 denarii annually. The surplus could accumulate, providing a buffer for years when mortality was higher than average, or funding occasional benefits like assistance for members who became disabled or fell on hard times. This is mutual insurance, fundamentally different from bottomry loans. The lender in a bottomry arrangement was an outsider, someone with capital seeking return. The collegium was a community of peers, people pooling their small contributions to protect each other. No one profited. The system existed to provide security, not to generate return. The collegia faced a problem that would become central to insurance theory: adverse selection. If membership was voluntary, who would join? Those who expected to benefit. A young, healthy worker might see little point in paying monthly dues for benefits he did not expect to need for decades. An older worker, already feeling the weight of years, would find the arrangement attractive. If only the old and sick joined, the collegia's finances would collapse. The costs would exceed the income. The system would fail. The solution was often compulsion or social pressure. Some collegia required membership as a condition of practicing a trade. Others operated in communities where social ties were so strong that opting out meant ostracism. The pressure to join kept the membership broad enough, the risk pool diverse enough, that the system could function. But the collegia remained small, local, limited in scope. They protected against 1 or 2 specific risks: death and occasionally disability. They could not protect a merchant's goods or a ship's cargo. They could not cover the complex risks of commercial enterprise. They existed alongside bottomry loans, addressing different needs, serving different functions. By the late Roman Empire, both practices were well established. Maritime lending with risk transfer was standard for seaborne trade. Mutual aid societies provided death benefits and basic support for widows. These were the 2 streams from which modern insurance would eventually flow: commercial risk transfer from bottomry loans, mutual protection from the collegia. But neither system had what insurance would require to fully develop. Neither had mathematics. Neither had systematic record-keeping about losses and probabilities. Neither had professional risk assessors who could price uncertainty with any precision. Neither had separated the function of providing capital from the function of bearing risk. Neither had created a dedicated industry, a set of institutions whose sole purpose was to absorb and distribute risk. Those developments would come later, much later, emerging slowly through the medieval period and the early modern era. But the foundation was present in the ancient Mediterranean. Humans had identified the fundamental problem. Uncertainty threatened survival, and had devised preliminary solutions. They had learned that risk shared is risk diminished. They had discovered that pooling resources across many people creates protection for each individual. They had begun the patient work of turning fear into arithmetic, of making the unpredictable manageable through collective action. The merchant in Athens who took a bottomry loan could sleep a bit easier, knowing that disaster would not mean total ruin. The baker in Rome who paid his monthly dues to the collegium could face old age with less dread, knowing his family would be cared for. The system was limited, imperfect, informal, but it worked. It functioned. It allowed commerce to continue, families to survive, communities to endure despite the ever-present possibility of loss. And it established patterns that would persist. The idea that uncertainty can be priced, that risk has a cost that can be expressed as an interest rate or a premium, the idea that many small contributions create substantial protection, the idea that institutions can be built around the management of risk, that this function is valuable enough to sustain specialized practices and practitioners. The Mediterranean had discovered insurance's core insight. Now it would take centuries for that insight to develop into mature institutions, for the informal practices of merchants and guilds to evolve into the complex industry that would eventually touch every aspect of modern economic life. But the seed was planted, the foundation was laid. The ancient world had shown that humans need not face uncertainty alone, that risk could be shared, that the many could protect the few through patient arithmetic and collective commitment. The ships continued sailing, the loans continued being made, the collegia continued collecting their dues and paying their benefits. And the slow accumulation of experience, the gradual refinement of practice, the patient learning about how risk behaves and how humans can manage it together, all of this continued, generation after generation, the foundation on which everything else would eventually be built. The Roman Empire faded. The Mediterranean trade networks that had sustained bottomry lending contracted. The collegia dissolved or transformed into something else. For centuries, the institutions that had managed maritime risk and provided mutual protection existed only in fragments, in local customs, in practices that persisted without formal organization. But the fundamental human needs did not disappear. Merchants still needed to move goods across dangerous routes. Families still needed protection against the death of a breadwinner. Workers still faced disability and destitution. The problems remained, and slowly, gradually, new solutions emerged from the medieval world, building on ancient foundations but adapted to different circumstances, different social structures, different economic realities. The medieval guild was not the Roman collegium, but it served similar functions and faced similar challenges. Picture a guild hall in Florence or Bruges or London, 1200 or 1300 or 1400. Stone walls, wooden benches, a meeting space where craftsmen gathered to regulate their trade, to maintain standards, to protect their collective interests. The guilds organised around specific crafts. There were guilds of weavers, of goldsmiths, of masons, of bakers, of shoemakers, of shipwrights. Each trade had its own organisation, its own rules, its own traditions. To practice a craft in a medieval city often required guild membership. The guild controlled who could enter the trade, what training was required, what quality standards must be met, what prices could be charged. But the guilds were more than trade associations. They were mutual protection societies, communities that cared for their members across the full span of life. And in caring for their members, they developed practices that would contribute to the evolution of insurance. A young man who wished to become a weaver in Bruges would begin as an apprentice, working for a master weaver for perhaps 5 or 7 years, learning the craft, receiving food and shelter, but no wages. After completing his apprenticeship, he would become a journeyman, working for wages, moving between different masters, building his skills and saving his money. Eventually, if he was successful and if the guild permitted it, he would become a master himself, opening his own workshop, hiring his own journeymen and apprentices, joining the guild as a full member with voting rights and obligations. Those obligations included paying regular dues to the guild. The amounts varied by trade and by city, but a typical figure might be £3 or £4 per year, perhaps 2 to 5% of a master craftsman's annual income. This was not optional. Guild membership required payment. Failure to pay meant expulsion from the guild, which meant the end of one's right to practice the trade, which meant economic ruin. Where did this money go? Some funded the guild's operating expenses, the hall itself, the officials who managed guild affairs, the feasts and ceremonies that marked the guild calendar. But much of it went to mutual aid, to providing for members who faced hardship. Death remained the primary concern, as it had been for the Roman collegia. A guild member who died would receive a proper funeral paid for by the guild. This was not charity. This was contractual obligation. The member had paid his dues for years, perhaps for decades. The guild owed him burial. The cost might be £5 or £10, depending on the elaborateness of the ceremony and the local customs. The guild would also support the deceased member's widow and children, at least for a time. A widow might receive an annual pension of £5 or £10 for several years, enough to feed and house a small family if they lived modestly. The children might be apprenticed within the guild at reduced cost or no cost, giving them a path into the trade their father had practiced. This support was limited in duration and amount. The guild could not support widows indefinitely, but it meant that a craftsman's death did not automatically mean destitution for his family. Disability posed a different challenge. A weaver who went blind could no longer practice his craft. A goldsmith who lost the use of his hands was finished as a craftsman. These events were less predictable than death, harder to plan for, more variable in their consequences. Some guilds provided modest support for disabled members, perhaps a small pension or help finding alternative work. Others did little beyond allowing disabled members to retain nominal guild membership without paying dues. The practices varied widely and remained informal, responding to individual cases rather than following systematic rules. The economics of guild mutual aid worked on the same principles as the Roman collegia, but at somewhat larger scale. A prosperous guild in a major city might have 150 or 200 master members. Each paying £3 or £4 annually created a collective fund of £500 to £800 per year. In a typical year, perhaps 3 or 4 masters would die. Funeral costs and initial widow support might consume £40 to £60. Ongoing widow pensions and apprenticeship support for orphans might cost another £30 to £50 annually. Total annual costs might be £70 to £100, leaving substantial surplus to accumulate for years when mortality was higher or when unusual expenses arose. This surplus accumulation was crucial. The guild needed reserves to handle variation. A plague year might kill 10 or 15 members instead of the usual 3 or 4. A particularly harsh winter might create multiple disability cases simultaneously. The accumulated reserves allowed the guild to meet these obligations without imposing special assessments on the surviving members. But maintaining adequate reserves required discipline and foresight. The temptation to spend the surplus on guild feasts or on beautifying the guild hall or on reducing annual dues was always present. Some guilds managed their finances carefully, maintaining substantial reserves, functioning for centuries without financial crisis. Others spent freely in good times and found themselves unable to meet obligations when losses mounted. There was no regulation, no external oversight, no requirement that guilds maintain any particular level of reserves. The quality of financial management depended entirely on the wisdom and discipline of guild leadership. The guilds also faced the adverse selection problem, though in different form than the Roman collegia. Guild membership was not purely voluntary. Practicing the trade required it, but guilds could and did restrict entry, limiting the number of new masters admitted. This restriction served economic purposes, preventing overcrowding of the trade, maintaining wage levels for existing members. But it also served financial purposes related to mutual aid. A guild that admitted too many older men, craftsmen nearing the end of their working lives, would face immediate increased costs for death benefits and pensions. By restricting entry, by favouring younger applicants who had completed full apprenticeships, guilds could manage their age structure and control their mutual aid costs. This worked as long as the guilds had power to enforce their rules, as long as cities granted them monopolies over their trades, as long as economic and political conditions supported the guild system. And for several centuries, from roughly 1100 through 1500, this was largely the case in much of Europe. The guilds flourished, they controlled urban crafts, they provided mutual protection for their members. They created stable communities within which craftsmen could practice their trades with some security against the worst economic shocks. But guilds protected only those within them. A labourer who worked for wages but was not a guild member had no access to guild benefits. A widow whose husband had not been a guild member received no pension. The rural population, which was most of Europe, had no equivalent institutions in many regions. Guild mutual aid was limited in scope, available only to the privileged minority who controlled skilled crafts in cities. Beyond the guilds, another form of medieval mutual protection emerged, the religious fraternity. These were associations of laypeople organised around devotion to a particular saint or around a particular church. Members gathered for religious observances, maintained chapels or altars, participated in processions and festivals, but they also provided mutual aid, often focusing on the same needs guilds addressed: burial, widow support, help for members facing hardship. The fraternities were more open than guilds. Membership did not depend on practicing a particular craft or on completing an apprenticeship. Anyone who could afford the dues and who was acceptable to existing members could join. This made fraternities accessible to a broader range of people, including merchants and professionals who were not craftsmen, women who could not join guilds, servants and labourers who had modest incomes but wanted protection for their families. The fraternities collected dues, typically smaller amounts than guild dues because the membership was less prosperous. A few shillings per year was common. The accumulated funds paid for masses for deceased members, for burial costs, for modest assistance to widows and orphans. The scale was smaller than guilds, the benefits more limited, but the principle was identical, pooling small contributions to provide protection against specific risks. Both guilds and fraternities operated locally. They were rooted in particular cities, particular parishes, particular communities. The protection they offered was limited to members and their immediate families. They could not address the risks facing long-distance merchants, the people who are moving goods across kingdoms and across seas, who face the same maritime dangers that had confronted ancient Mediterranean traders. For those merchants, for the renewal of long-distance trade in the later Middle Ages, different arrangements were needed. And gradually, over the 13th and 14th and 15th centuries, those arrangements emerged, particularly in the Italian maritime cities that were rebuilding Mediterranean commerce. The Hanseatic League, that association of merchant cities around the Baltic and North Sea, developed mutual protection arrangements among its members. A merchant whose goods were seized by pirates or by hostile rulers could appeal to the League. Other members might contribute to compensate his loss, or the League might retaliate against the offender using collective economic and military power to protect individual merchants. This was not insurance in a technical sense. There were no premiums, no systematic loss calculations, but it was risk-sharing on a larger scale than guilds or fraternities could manage. The Italian cities went further. In Genoa and Venice and Florence, maritime merchants began writing contracts that separated the loan from the risk coverage, moving beyond the ancient bottomry arrangement towards something more recognizably insurance. A merchant in Genoa in 1347 needed to send a cargo of cloth to Alexandria. The cargo's value was 1,000 florins. The merchant could have taken a bottomry loan, borrowing money at high interest with the loan forgiven if the ship sank. But instead he arranged something different. He purchased the cargo with his own funds. Then he entered a separate contract with a group of investors who agreed to bear the risk of the voyage in exchange for a payment. The contract specified the ship, the route, the cargo, the duration of coverage. It stated that if the ship was lost, if the cargo was destroyed or captured, the investors would pay the merchant 1,000 florins to compensate his loss. In exchange, the merchant paid the investors 150 florins immediately. This payment was not a loan to be repaid. It was a premium, a price for the transfer of risk. This is recognizably insurance. The function of providing capital has been separated from the function of bearing risk. The merchant owns the cargo outright, not with borrowed money. The investors are not lending. They are pure risk bearers, accepting the possibility of loss in exchange for a premium payment that is theirs to keep if the ship arrives safely. The premium rate in this example was 15% of the cargo value, a figure that reflects both the route's dangers and the lack of precise risk assessment tools. The investors were setting the premium based on their experience and intuition, on what they knew about Alexandria voyages, on how much compensation they required to accept this particular risk. There were no tables, no mathematical calculations, no systematic data about ship loss rates, just judgment and negotiation. The practice spread through the Italian maritime cities during the 1400s. Standard contract language developed. Certain terms appeared repeatedly: the insured value, the route, the duration, the perils covered, the premium rate. Disputes arose and were settled, creating precedents that shaped how future contracts would be interpreted. A body of commercial law around insurance contracts began to accumulate, but the separation of insurance from lending created a religious problem. The Catholic Church prohibited usury, the charging of interest on loans. The prohibition was complex. What exactly constituted forbidden interest versus legitimate compensation was debated endlessly. But the basic principle was clear and powerful. Christians should not profit from the mere passage of time, should not charge their brothers for the use of money. Bottomry loans had always existed in tension with usury prohibitions. Was the high interest on a bottomry loan legitimate compensation for risk, or was it forbidden usury? Theologians and canon lawyers argued both sides. The practice continued despite the uncertainty, partly because it was ancient and established, partly because the risk element seemed to distinguish it from pure interest-bearing loans. But insurance separated from lending was even more problematic. The premium payment was not interest on a loan. It was payment for bearing risk. The investors provided no capital to the merchant. They simply agreed to pay if certain events occurred, and they received payment whether those events occurred or not. This looked like gambling to some theologians. The merchant and the investors were making opposed wagers about the voyage's outcome. If the ship sank, the merchant collected. If the ship arrived safely, the investors kept the premium. This was betting on uncertain events, which the Church also condemned. The insurance practitioners and their legal advisors developed arguments to distinguish insurance from forbidden gambling. They emphasized that the merchant had a genuine economic interest in the cargo's safety. He was not simply betting on an outcome, he was protecting his livelihood. They noted that insurance reduced risk rather than creating it, that the merchant slept easier knowing his potential loss was limited, that this was socially beneficial rather than the moral hazard of gambling. They argued that the premium was fair compensation for a real service, for the investor's willingness to bear uncertainty that the merchant wanted to shed. These arguments gradually gained acceptance, though never universal acceptance. Insurance remained somewhat suspect in theological circles, but it was too useful, too beneficial to merchants, too profitable for investors to be suppressed. The practice continued and expanded despite the religious qualms. By 1500, maritime insurance was well established in the Mediterranean. Merchants routinely insured their cargoes on voyages to the Levant, to North Africa, to the Black Sea. The premium rates had stabilized somewhat. 12 to 15% was standard for normal routes in normal seasons, higher for dangerous routes or storm seasons. The contracts had become standardized enough that merchants knew what to expect, what terms would be offered, what protections they would receive. But insurance remained limited to maritime cargo. It had not extended to other risks, to fire, to life, to the countless other uncertainties that threatened medieval people. It remained a specialized tool for a specialized community, the international merchants whose trade depended on moving valuable goods across dangerous seas. The guilds continued to provide their mutual aid for craftsmen in cities. the fraternities continued to support their members with burial and modest assistance. The maritime merchants continued to insure their cargoes. These three streams, guild mutual aid, religious fraternity support, maritime insurance contracts, coexisted, each serving different needs, each operating by somewhat different principles, each contributing pieces that would eventually combine into the modern insurance industry. The mathematics remained primitive. No one was calculating probabilities in any systematic way. No one was maintaining careful records of loss rates that could inform future pricing. No one had developed professional actuarial practices. The premiums were set by negotiation and tradition, by what the market would bear, by rough intuition about risk rather than by precise calculation. The scale remained small. A guild might have 200 members, a fraternity might have 100. An insurance contract covered one cargo on one voyage. There were no large institutions, no companies with hundreds of employees or thousands of policyholders. Everything was local, personal, based on direct relationships and community ties. But the medieval world had advanced beyond the ancient. It had created mutual aid institutions that endured across generations, that provided systematic support for widows and orphans, that embedded protection against certain risks into the fabric of urban life. It had separated insurance from lending, creating pure risk transfer contracts that would become the template for all future insurance. It had begun to think about insurance in legal and theological terms, to develop frameworks for understanding when risk-bearing is legitimate commerce rather than forbidden gambling. The foundation was broader now, more developed. The next steps would require new economic conditions, new intellectual tools, new scales of organization. But the medieval centuries had built on the ancient foundations, had kept the practices alive, had refined them gradually through trial and error and experience. The patient accumulation of knowledge about how to manage risk collectively had continued. The slow evolution from informal custom to formal contract, from local community to specialized commerce, from intuition to the beginnings of system. The guild hall still stood. The fraternities still gathered for their masses and their processions. The merchants still met on the docks of Genoa and Venice to negotiate their insurance contracts. The practices continued, the protections functioned, the collective bearing of individual risks allowed commerce and craft and community life to persist, despite the ever-present possibility of loss. And the knowledge accumulated generation by generation that humans need not face uncertainty alone. That risk could be shared through patient agreement and careful organization, that the many could protect the few through institutions that would endure beyond any individual life, that this was worth paying for, worth organizing around, worth building into the structure of economic and social life. The medieval world passed this knowledge forward, keeping alive what the ancients had discovered, adding its own innovations, preparing the ground for what would come next. The medieval guilds and the Italian insurance contract had established practices that worked, but they remained scattered, local, limited in reach. What transformed insurance from scattered practices into an industry, from occasional contracts into systematic business, was a place and a time and a community of people who gathered daily to exchange information, to assess risk, to make agreements that would bind them for months or years into an uncertain future. London, 1686. A coffee house opens on Tower Street, near the docks where ships from across the world unload their cargoes. The proprietor is Edward Lloyd. His establishment is not remarkable initially. London has hundreds of coffee houses by this time, gathering places where men drink coffee and chocolate, read newspapers, conduct business, exchange gossip. Coffee houses have become the informal offices of London commerce, cheaper than renting dedicated space, more respectable than taverns, providing neutral ground where merchants and traders and captains can meet. But Lloyd's Coffee House develops a particular clientele. Ship captains frequent it, stopping there when they arrive in London to report on their voyages, to share news from distant ports, to seek their next employment. Ship owners come to find captains, to hear the latest shipping news, to learn which routes are dangerous and which are currently safe. Merchants involved in overseas trade gather there to exchange information about markets, about prices in foreign ports, about political conditions that might affect commerce. And gradually, inevitably, underwriters begin gathering there. These are men with capital, men willing to risk their money by insuring ships and cargoes, men who need information to assess the risks they are being asked to accept. They need to know which captains are competent and which are reckless. They need to know which routes are threatened by pirates or by war. They need to know which ships are well maintained and which are dangerously decrepit. They need to hear about recent losses, about storms that have scattered fleets, about ports where disease is raging. Lloyd's Coffee House becomes the place where this information concentrates. By 1700, by 1710, it is the centre of London's marine insurance market. The physical space is crowded, noisy, thick with tobacco smoke and the smell of coffee. Men gather in groups, papers spread on tables, contracts being negotiated, news being shared, the patient work of assessing and pricing maritime risk proceeding throughout the business day. The insurance contracts written at Lloyd's followed patterns established in the Mediterranean but adapted to English law and to the particular conditions of English trade. A typical contract might cover a ship sailing from London to Jamaica and return, carrying manufactured goods outbound and sugar and rum on the return voyage. The policy would specify the ship's name, the captain's name, the route, the duration of coverage, the amount insured. The amount insured might be £5,000 for a cargo of manufactured goods, cloth and metal goods and tools, being sent to Caribbean markets. The premium rate might be 8%, meaning the merchant paid £400 for the insurance coverage. If the ship and cargo were lost, if they sank or were captured or destroyed by fire, the underwriters would pay £5,000 to the merchant compensating his loss. If the voyage succeeded, the underwriters kept the £400 premium as their profit. But here is what made Lloyd's different from the scattered insurance practices that preceded it. The risk was not typically taken by a single underwriter. Instead, the contract would be shown to multiple underwriters in succession. Each would assess the risk and decide what portion he was willing to accept. One underwriter might write his name at the bottom of the policy for £500 of coverage, agreeing to pay that amount if the ship was lost. Another might add his name for £300, a third for £700. The process would continue until the full £5,000 was covered, the risk distributed across perhaps 8 or 10 or 12 different underwriters. This is the syndicate structure, the fundamental mechanism that allowed marine insurance to scale beyond what individual wealth could support. No single underwriter had to risk £5,000 on one voyage. Each risked only a fraction. Each could spread his capital across many policies, taking small portions of many different risks rather than large portions of a few risks. This diversification protected each underwriter from catastrophic loss, while allowing the total market to provide very large amounts of coverage. The underwriters were wealthy men, but not extraordinarily so by the standards of London's merchant class. A successful underwriter might have capital of £20,000 to £50,000. This was substantial wealth. A skilled craftsman might earn £50 per year, so £20,000 represented 400 years of such wages, but it was not enough to single-handedly insure the largest cargoes and ships. By syndicating the risk, by cooperating with other underwriters, each individual could participate in far more business than his capital would otherwise permit. The premium rate of 8% in the example above represents considerable uncertainty and risk. If ships were lost at a rate of 5%, one voyage in 20 ending in total loss, and if operating costs and profit margin consumed another 2 to 3%, then 8% premiums would provide adequate return. But determining the actual loss rate, knowing whether 8% was too high or too low, required information that no individual underwriter possessed. This is where Lloyd's Coffee House became crucial. The daily gathering of ship captains and merchants and underwriters created an information market alongside the insurance market. News travelled through the coffee house constantly. A captain just returned from the Caribbean would report which ports were safe, which were threatened by French privateers, where the hurricane season had been severe. A merchant with correspondents in Virginia would share letters describing conditions there. An underwriter who had just settled a claim on a ship lost in the North Sea would discuss what had gone wrong, whether the loss was due to storm or to poor seamanship or to inadequate maintenance. This shared information allowed underwriters to price risk with greater accuracy than their medieval predecessors. They still had no mathematical tables, no systematic mortality data, no actuarial science. But they had the accumulated experience of hundreds of voyages, the collective knowledge of a community that dealt with maritime risk daily, the constant flow of news about what was happening on the world's oceans. Edward Lloyd himself contributed to this information infrastructure. He began collecting and publishing shipping news, creating lists of ship departures and arrivals, recording losses, distributing this information to his customers. By 1734, this evolved into Lloyd's List, a regular publication providing shipping intelligence. Ship owners and underwriters and merchants subscribed to it, paying for access to the most current information available about maritime conditions. The information was not perfect. News travelled slowly. A ship lost in the Indian Ocean might not be known in London for 6 months or more. A hurricane in the Caribbean in September might not be reported in London until November. Underwriters made decisions based on incomplete and often outdated information, adding to the uncertainty they faced. But incomplete information was better than no information, and the concentration of the trade at Lloyd's meant that what information existed flowed through this single location. An underwriter who spent his days at Lloyd's, who listened to the captains and read Lloyd's List and discussed conditions with fellow underwriters, had access to more and better information than an isolated merchant in Bristol or Liverpool attempting to assess maritime risk. The policies written at Lloyd's evolved standard language to address common disputes. What counted as a covered loss? If a ship was damaged by storm but managed to limp into port, was that a partial loss requiring partial payment? If a captain deliberately destroyed part of the cargo to save the ship, throwing goods overboard to lighten the vessel in heavy seas, was that covered? If a crew mutinied and ran the ship aground, was that the same as shipwreck by natural causes? These questions generated disputes, and disputes generated legal proceedings, and legal proceedings generated precedents and principles. The courts developed a body of marine insurance law, interpreting policy language, establishing rules about what was covered and what was not. The underwriters learned from these cases, adjusted their policy language, developed clearer terms to avoid future disputes. One crucial principle that emerged was insurable interest. To purchase insurance, you had to have a genuine financial stake in what you were insuring. You could not simply bet on whether someone else's ship would sink. A merchant could insure his cargo because he owned it and would lose money if it was destroyed. A shipowner could insure his vessel. A creditor who had lent money secured by a cargo could insure that cargo up to the value of his loan. But a stranger with no connection to the ship or cargo could not purchase insurance on it. This principle distinguished insurance from gambling. In gambling, anyone can bet on any outcome. You can wager on a horse race even if you own no horse and have no interest in any of the competitors. Your bet creates risk where none existed before. But insurance requires pre-existing risk. The merchant already faces the possibility of losing his cargo. The insurance transfers that risk but does not create it. This distinction allowed insurance to remain legally and morally acceptable, even as gambling remained condemned. The insurable interest principle also addressed moral hazard. If anyone could insure a ship regardless of ownership, there would be incentive to destroy ships deliberately. A person who insured a ship for more than its value would profit from its loss. Limiting insurance to those with genuine financial interest reduced, though did not eliminate, this perverse incentive. Moral hazard remained a concern even with insurable interest requirements. A merchant who insured his cargo might take less care in packing it, might accept a less seaworthy ship, might choose a riskier route than he would if he bore the full risk himself. The insurance changed his incentives. The underwriters understood this and tried to address it through policy terms, requiring certain safety measures, excluding losses from specific causes that suggested negligence, but the problem could not be fully solved. Insurance always changes behaviour to some degree. Lloyd's developed mechanisms to reduce fraud and false claims. When a ship was reported lost, underwriters would investigate before paying claims. They would interview surviving crew members if any reached port. They would examine the ship's log if it was recovered. They would check whether the loss was consistent with reported weather conditions. If evidence suggested the captain had scuttled the ship deliberately or had staged a false loss, the claim would be denied and the merchant might face criminal prosecution. But investigation was difficult when ships were lost thousands of miles away, when evidence was at the bottom of the ocean, when only the captain's report could be relied upon. The underwriters had to balance thoroughness in investigation against the need to pay legitimate claims promptly. Merchants who faced long delays in receiving insurance payments would take their business elsewhere. The market required trust, required that claims generally be honoured without excessive suspicion. The business attracted specialised practitioners. Some men became professional underwriters, making their living entirely from accepting insurance risk rather than from trading goods or owning ships. They studied maritime conditions, developed expertise in assessing risk, built reputations for fair dealing and prompt payment. A merchant who needed insurance would seek out underwriters known for their integrity and their willingness to pay legitimate claims. Other men became insurance brokers, intermediaries between merchants seeking coverage and underwriters willing to provide it. The broker would approach multiple underwriters with a proposed policy, negotiating the premium rate, assembling a syndicate willing to cover the full amount. In exchange, the broker received a commission from the merchant, typically 1 or 2% of the insured amount. A policy for £5,000 might generate a brokerage commission of £50 to £100, enough to make the work worthwhile. The brokers provided value by knowing which underwriters specialised in which types of risk, by understanding current market conditions and what premium rates were fair, by having established relationships that allowed them to assemble syndicates quickly. A merchant new to insurance would find the market bewildering. Dozens of underwriters, unclear pricing, unfamiliar policy language. The broker simplified the process, made it accessible, reduced the transaction costs. By 1750, the Lloyd's market was handling enormous volumes of business. Thousands of policies were written each year, covering ships sailing to every corner of the world that English commerce reached. The total value insured might reach into the millions of pounds annually. The premiums collected represented substantial flows of money through the underwriting community. Some underwriters prospered greatly, accumulating fortunes from their careful assessment of risk and their willingness to accept uncertainty in exchange for premium payments. Others failed, ruined by clusters of losses that exceeded their capital, or by poor judgment about risks, or by fraud they failed to detect. The market was competitive, demanding, unforgiving of mistakes. But the market also required addressing a reality that troubled some participants and that would later trouble historians. Lloyd's underwriters regularly insured ships engaged in the Atlantic slave trade. A ship carrying manufactured goods to the African coast, then carrying enslaved people across the Atlantic, then returning with sugar or tobacco from the Caribbean. This was insurable at Lloyd's. The underwriters assessed the risks, set premium rates, wrote policies covering cargo that included human beings valued as property. The premium rates for these voyages were higher than for ordinary cargo, reflecting the mortality during the Middle Passage, the possibility of rebellion aboard ship, the longer duration of the complete circuit. But the trade was insured routinely, treated as ordinary business, recorded in the same ledgers, and handled by the same mechanisms as any other maritime commerce. This was profitable business for the underwriters. The premiums were high. The losses, while substantial, were generally within expected parameters. The system functioned smoothly, providing insurance coverage that made the triangular trade financially more feasible for the merchants who organised it. The moral reckoning with this would come later. In 1750, in 1760, in 1770, the underwriters at Lloyd's viewed this as they viewed insuring any other cargo. They were in the business of accepting risk in exchange for premiums. The nature of the cargo was not their moral responsibility, or so the reasoning went. They were not engaged in the trade itself. They were simply providing a financial service, spreading risk, enabling commerce. This rationalization would not survive scrutiny in later eras, but it functioned effectively in its own time, allowing intelligent and otherwise moral men to participate in a system whose human cost they either did not fully grasp or chose not to examine too closely. The premiums were collected. The claims were paid when ships were lost. The business continued. Beyond the slave trade, Lloyd's handled the full range of marine insurance. Ships carrying grain from the Baltic to England, ships carrying cloth from England to the Mediterranean, ships carrying tea from China around the Cape of Good Hope to London, ships carrying timber from North America, the patient accounting of maritime risk, the daily negotiation of premiums and coverage, the careful recording of policies and claims. All of this proceeded with remarkable consistency, creating a market that grew larger and more sophisticated each decade. The organisation remained informal. Lloyd's Coffee House was not a company or a corporation, it was simply a meeting place. The underwriters were independent operators, each risking his own capital, each making his own decisions about what risks to accept. There was no central authority, no regulatory oversight, no guarantee of any underwriter's solvency. If an underwriter failed to pay a claim, the other underwriters who had participated in that policy were not legally obligated to cover his share. The merchant might lose part of his coverage. This lack of formal structure would eventually create problems, would eventually require reform and regulation. But in the 1700s, the system worked adequately through reputation and social pressure. An underwriter who failed to honour his commitments would be excluded from the market, would find no brokers willing to bring him business, would see his livelihood destroyed. The social mechanisms of the close-knit underwriting community enforce standards that no law or regulation mandated. Lloyd's also published the Lloyd's Register, a classification of ships according to their condition and seaworthiness. Surveyors would inspect ships, assessing the hull's integrity, the quality of the rigging, the competence of the crew. Ships were rated A1, A2, and so on down to ships considered barely seaworthy. The ratings helped underwriters assess risk. A ship rated A1 commanded lower premiums than a ship rated poorly. Ship owners had incentive to maintain their vessels to high standards to qualify for better ratings and lower insurance costs. This created a virtuous cycle. Insurance required information about ship quality. The information system encouraged better maintenance. Better maintenance reduced losses. Lower losses allowed lower premiums. Lower premiums made insurance more affordable. More affordable insurance encouraged more trade. The system reinforced itself, each element supporting the others. By the late 1700s, Lloyd's had become the global centre of marine insurance, the place where risks from every ocean were assessed and priced and distributed among underwriters willing to accept them. Ships insured at Lloyd's sailed under many flags, English primarily, but also American after independence, and ships from other nations whose owners wanted the security of London insurance coverage. The accumulation of data, the daily flow of information, the hundreds of underwriters making thousands of individual decisions about premium rates, all of this was creating something that did not quite exist yet but was beginning to emerge. A collective understanding of maritime risk based on experience rather than on pure intuition. The beginnings of actuarial thinking, though actuaries as a profession did not yet exist for marine insurance. The underwriters could not calculate probabilities mathematically. They had no formal training in statistics. The field itself was just beginning to develop. But they had something valuable. Decades of observed outcomes, patterns that emerge from hundreds of voyages, a sense of what rates of loss were normal and what were exceptional. This experiential knowledge, accumulated across a community and passed through apprenticeship and through daily interaction, allowed the market to function with reasonable efficiency. The coffee house itself, The physical space where all this occurred was modest. A few rooms, wooden tables and benches, coffee served in ceramic cups, newspapers provided for customers. Men in coats and wigs, talking and negotiating and writing their agreements on slips of paper that would bind them to potentially enormous obligations. The contrast between the informal setting and the magnitude of the risks being transferred would have been striking to an observer, though the participants took it for granted. This was where modern insurance was becoming an industry, was separating from the scattered practices of guilds and medieval merchants to become a specialized business with its own practitioners, its own institutions, its own accumulated knowledge. The transition was not complete. Life insurance and fire insurance were developing separately, following different paths, but for marine risk, for the foundation of the industry, Lloyd's coffee house in London in the 1700s was the crucible where informal practice became systematic business, where individual risk-bearing became a market. The ships continued sailing, the underwriters continued gathering at Lloyd's, the policies continued being written, the premiums collected, the claims paid, and the patient work of managing maritime uncertainty, of allowing commerce to function despite the ever-present possibility of loss, continued through the accumulated individual decisions of underwriters who risk their capital on the calculation that most ships would return, that the premiums would exceed the losses, that the system would hold. It did hold. It grew, it prospered, and it created the template that insurance in other domains would follow. The gathering of information, the syndication of risk, the professional assessment, the standard contract language, the mechanisms for handling disputes, all of it emerging organically from the daily practice of men trying to make profitable business from accepting other people's uncertainty. The patient arithmetic of insurance becoming, in that crowded coffeehouse on Tower Street, a mature commercial enterprise. The ships insured at Lloyd's sailed across oceans, their cargoes protected against the perils of the sea. But in London itself, in the cities and towns across England and Europe, different risks dominated daily life. The ocean could swallow a ship and its cargo in a storm, certainly. But fire could consume a house and everything in it in a matter of hours. Death could leave a family destitute overnight. These risks were not maritime. They required different thinking, different structures, different solutions. The story of how insurance expanded beyond the sea begins with fire, and the story of fire insurance begins with a catastrophe that reshaped London and changed how people thought about protecting their property. September of 1666. A bakery on Pudding Lane near London Bridge. The fire starts sometime after midnight, perhaps from embers in the oven that were not properly extinguished. The bakery's timber structure catches quickly. The flames spread to neighbouring buildings. The night is dry, the summer has been hot, the city's buildings are pressed close together. Wood and thatch and pitch creating fuel for the fire to feed upon. By dawn, dozens of buildings are burning. By mid-morning, hundreds. The fire spreads faster than people can flee, faster than the primitive firefighting equipment can contain it. Water must be drawn from wells or from the Thames, carried in leather buckets, thrown onto flames that have already consumed entire streets. The effort is futile. The fire advances. It burns for 4 days. When it finally exhausts itself, having consumed everything flammable in its path, the damage is staggering. 13,000 houses destroyed, 87 churches including the old St. Paul's Cathedral, Countless shops and warehouses and guild halls, perhaps 400 acres within the city walls, reduced to ash and rubble. The total property loss exceeds £10 million, a sum so large it defies easy comprehension, perhaps equal to a full year's income for the entire nation. The human death toll was remarkably low, fewer than 20 deaths recorded, though this count surely missed many. But the economic destruction was total for those whose property burned. A shopkeeper whose building and inventory were consumed had lost everything. A landlord whose rental properties were destroyed had lost the source of his income. A merchant whose warehouse full of goods had burned had lost his entire capital, and there was no insurance. There had been no systematic fire insurance in London before 1666. Some wealthy individuals might have made private arrangements, informal agreements with others to provide mutual support in case of loss. But most property owners simply bore the risk themselves, hoping that fire would strike someone else, somewhere else, some other time. The Great Fire demonstrated the inadequacy of hope. After 1666, the question became unavoidable. Could fire risk be managed the way maritime risk was managed? Could insurance protect against the destruction of buildings and their contents? The first person to seriously attempt fire insurance in England was Nicholas Barbon. He was a physician by training, a builder and developer by profession, a man with capital and with entrepreneurial ambition. Barbon understood that the Great Fire had created both need and fear. Property owners wanted protection. They would pay for it if someone could offer credible coverage. In 1680, Barbon established the Fire Office, later known as the Hand-in-Hand Fire Office. This was not a mutual society where members protected each other. It was a commercial enterprise, a business designed to generate profit by accepting fire risk in exchange for premiums. Barbon offered to insure brick and timber buildings in London for annual premiums, calculated as a percentage of the property's value. The premium structure was straightforward. For a brick building, considered much safer than timber, the annual premium might be 2.5% of the building's insured value. For a timber building, 4 or 5%. A brick house valued at £400 would cost £10 per year to insure. A timber house of the same value would cost £20 per year. These rates seem high compared to modern insurance, but they reflected several realities. Fire losses in 17th century London were frequent. Buildings were crowded together. Firefighting capability was minimal. Once a fire started in a structure, total destruction was likely. The insurance had to price in these expected losses while also covering operating expenses and providing profit to Barbon and his investors. The policies Barbon offered included an innovation that addressed moral hazard. The Fire Office would maintain its own fire brigade, a group of men equipped with pumps and ladders and buckets, who would respond to fires in insured buildings. Each insured property received a fire mark, a metal plate affixed to the building's exterior, identifying it as insured by the Fire Office. When fire broke out, the brigade would respond, checking for the fire mark. If the building carried the mark, the brigade would fight the fire vigorously, trying to save the structure and minimize the loss. If the building was not insured, the brigade might still help, but their priority was protecting insured properties. This created incentives for the property owner to prevent fires and to maintain their property in good condition. But it also created practical fire protection. The brigades were more effective than the ad hoc neighbourhood responses that had previously been the only organised firefighting. Buildings with fire marks had better chances of survival if fire broke out. The economic logic of fire insurance differed from marine insurance in important ways. Marine insurance covered a cargo for a single voyage. The voyage ended, the contract concluded. The relationship between underwriter and merchant terminated unless they chose to write another policy. Fire insurance was ongoing. The building remained in place year after year. The policy renewed annually. The relationship between insurer and property owner was continuous, not episodic. This created different financial structures. Marine underwriters collected their premium and then waited to see if the ship returned. Their capital was tied up for months until the voyage concluded. Fire insurers collected premiums annually and faced potential claims throughout the year. They needed to maintain reserves, to hold funds available to pay claims when fires occurred, because claims would come unpredictably across the year. The reserve requirement was crucial. Barbon's fire office needed to accumulate enough capital to pay claims even in years when fires were more frequent than average. If a major conflagration struck a neighbourhood with many insured properties, the claims could be enormous. The office needed resources to pay those claims without failing. Barbon and his successors developed rough rules about reserves. They tried to maintain capital equal to at least 1 or 2 years' worth of expected claims. If annual premiums were £2,000 and expected claims were £1,200, the office should hold capital of perhaps £1,500 to £2,500 beyond the immediate premium income. This provided buffer against worse than expected loss years. The business attracted competition. Other entrepreneurs saw Barbon's success and established their own fire insurance offices. The Friendly Society was founded in 1683. The Hand-in-Hand Mutual Fire Office, confusingly similar in name to Barbon's Hand-in-Hand but actually a mutual society rather than a commercial enterprise, was established in 1696. Each office had its own fire brigade, its own fire marks, its own premium structure. The competition drove some innovations. The offices tried to attract customers by lowering premiums slightly, by offering better service, by maintaining more effective fire brigades. But they also cooperated in certain ways. When a major fire threatened multiple insured properties, the brigades from different offices would work together, recognizing that a fire uncontrolled would spread and damage everyone's insured properties. The self-interest of each office aligned with collective firefighting effort. The expansion of fire insurance created demand for better information about fire risk. Which buildings were most dangerous? Which occupations created fire hazards? How should premiums vary based on the building's construction, its location, its use? The offices began conducting surveys before issuing policies. A surveyor would inspect the building, noting its construction, brick or timber, slate roof or thatch, proximity to other buildings, presence of chimneys and fireplaces, occupancy and use. A bakery with ovens burning constantly was riskier than a residence. A warehouse storing flammable goods was riskier than one storing ceramics. The surveyor's report would inform the premium calculation. This created the practice of underwriting for fire insurance, assessing the specific risk before accepting it and pricing it accordingly. Each building was different. Each presented unique combination of risk factors. The premium needed to reflect this variation. A standard rate would mean that owners of low-risk properties subsidized owners of high-risk properties, creating adverse selection, as the low-risk owners chose not to insure. But implementing risk-based pricing required considerable information and judgment. The surveyor needed experience to recognize hazards. The office needed data about how different risk factors correlated with actual losses. This knowledge accumulated slowly through the patient observation of which buildings burned and which did not, which occupations generated more fire claims, which construction methods proved most resistant to fire. By the mid-1700s, fire insurance was well established in London and spreading to other British cities. Multiple competing offices offered coverage. Most substantial properties carried fire insurance. The annual premiums provided steady income to the insurance offices. The claims were paid when fires occurred. The system functioned. But fire insurance remained property insurance, protecting things. The expansion of insurance to cover human life required different thinking, different mathematics, different structures entirely. The problem of how to insure life had troubled thinkers for centuries. Life insurance, or rather death insurance, since the payout came upon death, seemed morally problematic. Was it not morbid, even sinful, to profit from another person's death? Did it not create terrible incentive for murder? If you insured someone else's life and collected upon their death, you had direct financial interest in their demise. The English law addressed this concern through the insurable interest doctrine, already established for marine insurance. You could only insure a life if you had legitimate financial interest in that person's continued survival. A wife could insure her husband's life because she depended on his income. A creditor could insure a debtor's life up to the value of the debt. A business partner could insure another partner. But you could not insure a stranger's life, could not speculate on when random people would die. Even with insurable interest, life insurance remained problematic. How should the premium be calculated? For marine insurance, the premium reflected the probability the ship would not return. For fire insurance, the premium reflected the probability the building would burn. These probabilities could be estimated from experience. But probability of death was more complex. Everyone dies eventually. The question is when. A policy issued to a 20-year-old might not pay out for 60 years. A policy issued to a 60-year-old might pay out within 5 years. The timing mattered enormously for the financial calculations. If the insurance office charged a flat annual premium regardless of age, young, healthy people would be subsidizing old people, and the young would choose not to buy coverage. The medieval guilds and burial societies had avoided this problem by limiting membership to people in specific age ranges, by charging dues that roughly covered average costs across their membership, but this created adverse selection and limited the potential market. A true life insurance industry needed to price policies based on individual mortality risk, and that required understanding mortality patterns mathematically. The crucial breakthrough came from an unexpected source, an astronomer studying population statistics. Edmond Halley, famous for the comet that bears his name, became interested in mortality data from the city of Breslau in Silesia. The Breslau records tracked births and deaths systematically over several years, providing data about mortality rates at different ages. Halley analysed this data and constructed what would become known as a life table. He calculated for each age what proportion of people survived to the next age. From these proportions, he could determine life expectancy, how many years on average a person of a given age could expect to live. The table Halley published in 1693 showed patterns that seem obvious now but were revolutionary then. Infant mortality was high. Many children died before age 5. Those who survived childhood had reasonable probability of reaching adulthood. Mortality increased gradually through the middle years and then accelerated in old age. By 70, most people had died. Survival past 80 was rare. These patterns allowed mathematical calculation of insurance premiums. If you knew that a 40-year-old man had, say, 60% probability of surviving 20 years, you could calculate what premium to charge for a 20-year insurance policy. The premium needed to equal the expected payout, discounted for the time until payment, plus a margin for expenses and profit. The mathematics was more complex than it appeared. The premiums would be collected over time, not all at once. They could be invested, generating return. The timing of death affected the total premiums collected before payout. The interest rate assumption mattered significantly to the calculations. But the fundamental principle was clear. Mortality could be quantified, and quantified mortality allowed rational pricing of life insurance. The first life insurance organization to use these mathematical principles was the Equitable Life Assurance Society, founded in London in 1762. The word equitable referred to the society's innovation, premiums calculated fairly based on age. A 25-year-old paid less than a 40-year-old, who paid less than a 60-year-old. Each paid according to their mortality risk. Equitable was a mutual society, owned by its policyholders rather than by external investors. Any surplus, premiums collected beyond the amounts needed to pay claims and expenses, would be distributed back to policyholders as bonuses. This structure aligned the interests of the organization with those of its members. The society wanted to charge fair premiums, invest wisely, pay legitimate claims, and return excess to members. The policies Equitable offered were typically whole life policies, meaning they remained in force for the insured person's entire life, however long that might be. The premium remained level, the same amount each year, rather than increasing with age. This required careful calculation. The premium in early years would be more than the immediate mortality risk justified, creating surplus. That surplus would be invested. In later years, when mortality risk increased and the level premium was less than the true risk, the accumulated surplus and its investment returns would cover the difference. The level premium was elegant mathematics, but also good marketing. Paying the same amount each year was simpler, more predictable, easier for policyholders to budget. The alternative, premiums increasing each year as the insured aged, would be accurately risk-based but psychologically difficult. People would face rising costs as they aged, and their income potentially declined. The death benefit was typically fixed at policy issue. A person might purchase a policy for £500, meaning that upon their death, their beneficiary would receive £500. This sum might represent several years of income for a middle-class family, enough to provide a cushion while the widow found alternative means of support or the children reached working age. The premiums for such policies varied by age at purchase. A 25-year-old might pay £4 or £5 annually for a £500 policy. A 40-year-old might pay £8 or £9. A 60-year-old might pay £25 or £30. These amounts were significant but manageable for the professional and merchant classes that were Equitable's primary market. A clerk earning £100 per year could afford £5 annually for life insurance. A merchant earning £300 per year could afford £10 or £15. But most of the working poor could not afford life insurance at these prices. A labourer earning £30 per year could not spare £4 or £5 for insurance premiums. The earliest mathematical life insurance served primarily the middle and upper classes, those with enough income that a portion could be devoted to protecting against future uncertainty. The life insurance offices faced different challenges than marine or fire insurers. Their obligations extended decades into the future. A policy issued to a 25-year-old might not pay out for 50 or 60 years. The office needed to remain solvent across that entire period, needed to invest premiums wisely to generate returns that would help pay future claims, needed to maintain reserves sufficient to meet obligations that extended far beyond any individual manager's career. This required conservative management, careful investment policies, regulatory oversight. The British government began regulating life insurance in the late 1700s and early 1800s, requiring offices to maintain adequate reserves, limiting their investment options to relatively safe securities, imposing disclosure requirements so potential purchasers could assess the office's financial strength. The reserves were calculated using the same mortality tables that informed premium pricing. For each policy in force, the office calculated the expected future payout discounted to present value, minus the expected future premium income similarly discounted. The difference was the reserve that needed to be held. Across all policies, the total reserves represented the office's obligation to future policyholders. These reserves grew to enormous sums. By 1800, the major life insurance offices held reserves in the hundreds of thousands of pounds. By mid-century, the largest offices held millions of pounds in reserves. This capital needed to be invested conservatively, in government bonds, in high-quality corporate debt, in mortgages secured by real property. The investment income supplemented premium income, allowing the offices to pay claims, cover expenses, and accumulate surplus. The life insurance offices became major institutional investors among the largest holders of government debt, significant financiers of infrastructure and industrial development. The patient accumulation of premiums from thousands of policyholders invested carefully over decades created capital pools that funded railways and canals and industrial expansion. The life insurance industry was not merely protecting families against mortality risk. It was channeling middle-class savings into productive investment, connecting small individual premium payments to large-scale economic development. The calculation of mortality risk continued to improve as more data accumulated. The life insurance offices tracked their own policyholders' deaths, building datasets larger and more detailed than Halley's original Breslau table. They discovered that insured lives had lower mortality than the general population, partly because people who were already sick did not purchase insurance, partly because those wealthy enough to afford insurance tended to have better nutrition and living conditions. This led to medical underwriting. Applicants for life insurance would be examined by a physician who would assess their health, ask about their family medical history, inquire about their occupation and lifestyle. Someone with signs of tuberculosis would be declined. Someone in a dangerous occupation might be charged higher premiums. Someone from a family with history of early death might face extra charges. The medical examination created adverse selection concerns. People knew their health better than insurers did, but it helped control costs by excluding the worst risks. The profession of actuary emerged from the mathematical work of pricing and reserving life insurance. An actuary was a specialist in the mathematics of mortality and of long-term financial obligations. The profession formalized in the mid-1800s with the founding of the Institute of Actuaries in London in 1848. Actuaries developed professional standards, created examinations to certify competence, built bodies of knowledge about mortality and investment and reserve calculation. The actuarial profession brought scientific rigour to insurance. The rough intuition of marine underwriters and the experience-based judgment of fire surveyors were supplemented by mathematical calculation. Life insurance could be priced precisely. Reserves could be calculated accurately. Financial projections could be made with confidence. The transformation of insurance from art to science, from intuition to calculation, was substantially complete by the late 1800s. But fire and life insurance, even as they matured, remained separate industries from marine insurance. The marine underwriters still gathered at Lloyd's, syndicating risks, writing policies on individual voyages. The fire offices maintained their brigades and their fire marks. The life offices collected their level premiums and accumulated their reserves. Each domain had its own practices, its own culture, its own institutions. What unified them was the underlying principle. Risk could be managed through pooling. Many people facing small probability of large loss could protect themselves by each contributing small amounts to a collective fund. The mathematics worked. The social benefit was clear. Families protected against destitution. Merchants protected against ruin. Property owners protected against destruction. The patient arithmetic of insurance, calculating probabilities and collecting premiums and paying claims, made modern economic life more stable, more predictable, more bearable. The promise written in those insurance policies, the promise that began on parchment with wax seals in a London office in 1750, was being kept. Not perfectly, there were disputes and failures and injustices, but systematically across thousands of transactions, year after year, the insurance offices and underwriters honoured their commitments. They paid when ships sank. They paid when buildings burned. They paid when policyholders died. The system worked. And in working, it transformed how people related to uncertainty, how they planned for the future, how they managed risk. The expansion from sea to land, from property to life, was complete. Insurance had become woven into the fabric of modern economic existence, essential and largely invisible, the patient machinery that allowed people to face tomorrow with less fear, to invest and build and plan knowing that catastrophe would not mean total ruin, that the burden of loss would be shared, that the many would protect the few through the elegant mathematics of pooled risk and patient calculation. The mathematical life insurance developed by Equitable, the fire insurance pioneered by Barbon, the marine insurance perfected at Lloyd's, these remained primarily British institutions through the late 1700s. But the 1800s would transform insurance from a scattered collection of national practices into a global industry, from small-scale enterprises serving local markets into massive institutions managing capital that rivaled government budgets. The transformation came with industrialization. The factories that began appearing across England and then across Europe and America created risks that earlier centuries had never faced. A medieval craftsman worked in his home or in a small workshop, using hand tools, facing limited danger beyond the normal hazards of life. An industrial worker in 1820 or 1840 worked in a factory powered by steam engines, surrounded by machinery that could crush or maim, in buildings that could burn or collapse, facing dangers that were new and that existing insurance arrangements were not designed to address. Consider a textile mill in Manchester in 1830. The building might be 4 or 5 stories high, built of brick but with timber floors and interior structures. The machinery, power looms driven by leather belts connected to steam engines, filled the work floor with moving parts, with noise, with danger. The workers, many of them women and children, tended the machinery for 12 or 14 hours daily. The cotton fibre that filled the air was flammable. The oil that lubricated the machinery created fire hazard. The entire structure was a concentration of risk, unlike anything that had existed before. If fire broke out, the timber interior would burn rapidly. The workers on upper floors might be trapped. The stairways consumed before they could escape. The machinery represented enormous capital investment, thousands of pounds worth of equipment that would be destroyed. The inventory of cotton and finished cloth would be lost. The building itself might be damaged beyond repair. A single fire could inflict tens of thousands of pounds in damage. Factory fires occurred with grim regularity through the early 1800s. The fire insurance offices that had developed to protect houses and shops and warehouses adapted to cover industrial property, but the adaptation required new thinking about risk. A factory was not like a house. The concentration of value was much greater. The fire risk was elevated by the processes occurring inside. The potential for catastrophic loss, many workers killed, massive property damage, was substantial. The insurers responded by charging higher premiums for industrial properties, by requiring safety measures, by maintaining their fire brigades to respond quickly when fires occurred. But they also faced a new question. What about the workers themselves? If a worker was killed or maimed by machinery, if a breadwinner died in a factory fire, his family faced destitution just as if he had died from disease. Should there be insurance for this? The existing life insurance was available to those who could afford it. A factory worker earning £40 or £50 per year could not spare £5 or £10 annually for life insurance premiums. The mathematical life insurance developed for the middle class was economically out of reach for the industrial working class. Some employers began offering rudimentary accident insurance or death benefits to their workers, funded through deductions from wages or through employer contributions. These were not insurance in a formal sense. There were no written policies, no guarantees, no external regulation. But they represented recognition that industrial work created risks that needed to be addressed somehow. The railroads created entirely new categories of risk. When the first passenger railways began operating in the 1830s, they introduced novel dangers. Trains could derail, boilers could explode, collisions could occur, and when accidents happened, they could kill or injure dozens of people simultaneously, passengers and railway workers alike. Railway accidents generated substantial public concern. These were new dangers, technological risks that previous generations had not faced, and they seemed somehow more troubling than traditional risks. A person thrown from a horse and killed had suffered misfortune. A person killed in a train crash had been betrayed by modern technology, by the promise of safe, rapid travel. The first accident insurance appeared in response to railway risks. The Railway Passengers Assurance Company was established in London in 1848, offering policies that covered death or injury resulting from railway accidents. A passenger could purchase a policy for a single journey for a penny or twopence, receiving coverage of perhaps £1,000 if killed in an accident. This was the first insurance specifically covering accidental death rather than death from any cause. The accident insurance expanded beyond railways to cover other accidents. falls, drownings, injuries from machinery, any sudden misfortune that resulted in death or disability. The premiums were modest because most people did not die in accidents. Mortality from disease and old age far exceeded mortality from accidents. Accident insurance could be offered much more cheaply than comprehensive life insurance. The broader casualty insurance industry emerged from accident insurance. By the late 1800s, insurers offered coverage for employer liability, the legal obligation employers faced if workers were injured on the job. The coverage protected the employer, paying damages if a worker successfully sued for compensation. This addressed the risk from the employer's perspective, but did not directly help the injured worker, who still had to prove negligence in court to receive compensation. The workers' compensation movement, which began in Germany under Bismarck in 1884 and spread gradually to other nations, created compulsory insurance systems where employers had to provide coverage for workplace injuries regardless of fault. The worker injured on the job would receive compensation automatically, paid by insurance that the employer was required to maintain. This transformed industrial relations, creating guaranteed protection for workers while limiting employers' open-ended liability. The insurance companies that provided workers' compensation coverage faced the challenge of pricing premiums for different industries and different occupations. Coal mining was far more dangerous than office work. The premiums needed to reflect this variation. The insurers developed classification systems, categorizing occupations by risk level, charging higher premiums for dangerous work. This created incentives for safety. An employer who reduced accidents in his workplace could qualify for lower insurance premiums. The insurance mechanism channeled economic self-interest toward worker protection. This was not altruism, it was cost reduction, but the effect was beneficial. Factories began installing safety equipment, training workers in safe practices, implementing rules to prevent accidents, all partly motivated by the desire to lower insurance costs. The proliferation of insurance types continued through the late 1800s. Theft insurance protected against burglary and robbery. Plate glass insurance covered the large display windows that shops increasingly used. Boiler insurance protected against steam boiler explosions, a significant industrial hazard. Credit insurance protected businesses against customer defaults. Fidelity insurance protected employers against employee theft or embezzlement. Each new type of insurance required developing expertise in that particular risk, understanding what caused losses, how to prevent them, how to price coverage appropriately. The insurance industry was accumulating specialized knowledge across an expanding range of risks, building institutions and practices for managing uncertainty in an industrial economy. The scale of the insurance industry grew dramatically through the century. In 1800, the largest British life insurance companies had perhaps 10,000 policyholders and reserves of a few £100,000. By 1900, the largest companies had hundreds of thousands of policyholders and reserves measured in tens of millions of pounds. Similar expansion occurred in fire and marine and casualty insurance. This growth required new organizational forms. The small offices and partnerships that had dominated insurance in the 1700s were inadequate for the scale of business by the late 1800s. Large insurance companies emerged, corporations with hundreds or thousands of employees, with branches across the nation and eventually across the world, with professional management hierarchies. The typical large insurance company by 1900 had a head office, with senior managers and actuaries and accountants. It had dozens or hundreds of branch offices across the country, each managing local business. It had thousands of agents, salesmen who went door to door or office to office selling policies, earning commission on each sale. The agent became the public face of insurance, the person ordinary citizens encountered when purchasing coverage. The agents worked on commission, typically earning 50 to 90% of the first year's premium as their payment, then smaller percentages on renewals. This created powerful incentives to sell, but also created incentive problems. Agents had reason to sell policies to anyone regardless of whether the coverage was appropriate or whether the applicant could truly afford the premiums. Agents had reason to exaggerate the benefits and downplay the limitations of policies. The companies struggled to manage their agent forces, to maintain standards, to prevent fraud and misrepresentation. The agent commission structure also affected company finances. The high first-year commission meant that new policies were expensive to acquire. The company paid out most of the first year's premium as commission, leaving little to cover claims and expenses. The business model depended on policies staying in force for many years, on policyholders continuing to pay premiums year after year. If policies lapsed after 1 or 2 years, the company lost money on them. Policy lapsing was common, particularly for life insurance sold to working-class customers. A family might purchase life insurance when times were good, when income was steady. Then hard times would come. Unemployment, illness, unexpected expenses. The life insurance premium, however modest, became unaffordable. The policy would lapse. The family lost the coverage they had paid for, and all the premiums paid became profit for the insurance company. The companies understood this dynamic and profited from it. The lapse rates, the percentage of policies that terminated before maturity, might be 40 or 50% or even higher for some companies and some types of policies. The lapse policies contributed premium revenue without generating claims. The companies could price their policies assuming high lapse rates, offering coverage that looked affordable, but that many policyholders would not maintain. This created ethical concerns. Was the industry preying on the working poor, selling them policies they could not maintain, profiting from their financial distress? Some critics thought so, and called for regulation to protect consumers. Others argued that people should manage their own finances, that those who let policies lapse had made their own choices, that the insurance companies were providing a service that some people successfully used even if others did not. The American insurance industry developed somewhat differently from the British, though following similar patterns. American companies grew rapidly in the late 1800s, selling life insurance and fire insurance across the expanding nation. Some became massive enterprises rivaling the largest British companies in size and in capital. The American companies also developed products that British companies had not emphasized. Tontine insurance became popular in America in the late 1800s. This was a complex form of life insurance where policyholders who kept their policies in force for a specified period, typically 20 years, would share in a large payout funded by the lapsed policies and the deaths among the group. The survivors after 20 years might receive 2 or 3 times their premiums back, creating incentive to maintain coverage. But tontine insurance created problems. The complexity made it difficult for policyholders to understand what they were purchasing. The companies made extraordinary profits from the lapse policies while using the promise of the tontine payout to justify high premiums. regulators eventually scrutinized tontine insurance, and scandals in the early 1900s led to its prohibition and to broader reforms in American insurance regulation. Regulation of insurance expanded significantly in the late 1800s. The early insurance companies had operated with minimal oversight. If a company failed, policyholders lost their coverage and their paid premiums. If a company engaged in fraud, there was limited recourse. The growth of the industry, the enormous sums involved, the importance of insurance to millions of families, all of this created pressure for government oversight. Massachusetts had established the first insurance regulatory office in America in 1807, but serious regulation did not begin until later in the century. By the late 1800s, most American states and many European countries had insurance regulators who examined company finances, verified that adequate reserves were maintained, investigated consumer complaints, and had authority to shut down companies that were insolvent or fraudulent. The British regulation remained less centralised, relying more on company disclosure and on professional standards enforced by actuaries and by the industry itself. But the principle was established across the developed world. Insurance companies, because they held money in trust for future policyholders, because they performed essential social functions, because their failure could harm thousands of people, required regulatory oversight. Reinsurance developed as a crucial mechanism for insurance companies to manage their own risks. An insurance company that had sold thousands of fire policies in a particular city faced concentration risk. A major conflagration could generate hundreds of claims simultaneously, potentially exceeding the company's capital. To protect against this, the company could purchase reinsurance from another company, transferring part of the risk. The reinsurance contract might specify that if total fire losses in a year exceeded, say, £100,000, the reinsurer would pay 80% of the excess. This protected the primary insurer from catastrophic loss years while allowing them to continue writing large volumes of business. The reinsurer, typically operating internationally and covering risks across many regions, could diversify the concentration risk that each primary insurer faced. The first dedicated reinsurance companies appeared in Germany in the mid-1800s, Cologne Re in 1846, Munich Re in 1880. Swiss Re followed in 1863. These companies specialized in accepting risks from primary insurers, spreading those risks across their international operations. Reinsurance allowed the insurance industry to write much larger volumes of coverage than any single company's capital could support. By 1900, the global insurance industry had been transformed. In 1800, insurance had been a small-scale business concentrated in a few cities, serving primarily the merchant and professional classes. By 1900, insurance had become a major industry employing hundreds of thousands of people, managing capital measured in hundreds of millions of pounds or dollars, serving customers across all social classes, covering risks from death and disability to fire and theft to industrial accidents and employer liability. The actuarial profession had matured, developing sophisticated mathematical techniques for pricing and reserving. The Institute of Actuaries in London and the Actuarial Society of America, founded in 1889, created professional standards and examinations. An actuary was no longer merely someone who calculated insurance premiums. An actuary was a certified professional with years of mathematical training, expert in statistics and finance and demography. The insurance companies themselves had become major financial institutions. A large life insurance company by 1900 might hold reserves of 20 or 30 million pounds invested in government bonds and corporate securities and mortgages. These companies were among the largest institutional investors, moving capital markets through their investment decisions, funding industrial expansion and infrastructure development. The social impact was equally substantial. Middle-class families could protect themselves against breadwinner death through life insurance. Working-class families had access to industrial life insurance, modest policies sold by agents who collected premiums weekly door to door. Property owners could protect against fire through fire insurance that had become routine and relatively affordable. Employers could manage their liability exposure through casualty insurance. The economy functioned more smoothly because risk could be managed, because catastrophe did not automatically mean ruin. But the transformation had costs. The high commission structure meant that much of what policyholders paid went to agent commissions rather than to coverage. The lapse rates meant that many working-class families paid premiums for years and then lost coverage when they could no longer afford to continue. The complexity of some products, like tontine insurance, created opportunities for companies to profit from consumer confusion. The industry faced recurring scandals about executive compensation, about misleading sales practices, about companies using policyholders' money for improper purposes. The regulatory response to these problems was gradual reform. American states required more disclosure, limited certain practices, imposed standards for reserves and investments. British regulation remained lighter, but professional norms strengthened. The industry largely cleaned up the worst abuses by the early 1900s, though tensions between profit motive and policyholder protection would recur throughout the industry's history. The 19th century had industrialized insurance just as it had industrialized manufacturing. The small workshops had become factories. The craftsmen had become machine operators. The scale had expanded beyond anything earlier generations could have imagined. The patient arithmetic of pooling risk remained the same. Many people contributing small amounts to protect each against catastrophic loss. But the implementation had been transformed by scale, by technology, by organizational sophistication, by mathematical precision. The insurance industry entering the 20th century was recognizably modern. The institutions, the practices, the regulatory frameworks, the professional standards, all of these would continue to evolve, but the fundamental structure was in place. Insurance had become essential infrastructure for modern economic life, as necessary as banks and stock markets, as ubiquitous as the railroads and telegraph lines that connected the industrial world. The promise written on that parchment policy in 1750 had expanded beyond anything those early underwriters could have imagined. Millions of policies now, held by families and businesses across the developed world. Billions of pounds of capital backing those policies, invested in the bonds and stocks and mortgages that funded economic growth. An industry employing hundreds of thousands, from actuaries calculating reserves to agents selling policies door to door to claims adjusters, investigating losses to fire brigades responding to alarms. And through it all, the same fundamental transaction occurring millions of times, someone facing uncertainty paying a premium to transfer risk to an institution that would bear it, that would pool it with countless other risks, that would pay when loss occurred. The many protecting the few, year after year, policy after policy, claim after claim, the patient machinery of insurance functioning largely invisibly, allowing modern life to proceed with less fear, less anxiety, less vulnerability to the accidents and misfortunes that had always threatened human security. The 19th century ended with insurance thoroughly woven into economic and social life. The 20th century would test whether the system could endure shocks far greater than the fires and shipwrecks and railway accidents it had learned to manage. Whether it could face catastrophes that killed thousands simultaneously, that destroyed entire cities, that threatened the solvency of even the largest companies. Those tests would come. But first, the patient accumulation of experience, of capital, of knowledge about managing risk, the steady expansion of coverage and refinement of practice, all of this continued into the new century, the insurance industry entering 1900 larger, more sophisticated, more essential than ever before. The insurance industry had developed systems for managing ordinary risks, individual deaths, individual fires, individual accidents. The mathematics worked because losses were scattered randomly across time and space, because fire in Manchester did not predict fire in Liverpool, because one person's death did not make another's more likely. The fundamental assumption underlying all insurance was that risks were independent, that the many could safely protect the few because the few facing loss at any moment remained few. But what happens when this assumption fails? When losses concentrate in time and space? When hundreds or thousands of insured properties burn simultaneously? When a single event generates more claims than the insurance companies ever anticipated facing at once? The industry had pondered these questions theoretically. The early 1900s would answer them practically, through catastrophes that tested the system's resilience and exposed its limitations. April 18th, 1906. San Francisco, a city of 400,000 people, the commercial center of the American West. At 13 minutes past 5 in the morning, the earth begins moving. The San Andreas fault running beneath the city shifts. The earthquake lasts perhaps 45 to 60 seconds. Buildings collapse immediately. Brick structures that cannot flex with the ground. Wood frame buildings that slide off their foundations. Chimneys that topple and crash through roofs. But the earthquake damage, severe as it is only the beginning. The shaking breaks gas lines throughout the city. The broken gas lines ignite. Fires begin in dozens of locations simultaneously. The earthquake has also broken water mains, making firefighting nearly impossible. The fires spread through the wooden structures that dominate residential neighborhoods, leap across streets, merge into conflagrations that consume entire city blocks. The fires burn for 3 days. The city's fire department, hampered by lack of water, unable to contain the multiple simultaneous blazes, can only try to create fire breaks by dynamiting buildings in the fire's path. Sometimes this works. Often it simply spreads burning debris further. The fire advances block by block, consuming everything flammable, leaving only brick walls and rubble and ash. When the fires finally exhaust themselves, the damage is staggering. More than 28,000 buildings destroyed, 500 city blocks reduced to ruins. The total property loss approaches $500 million, an almost incomprehensible sum, and of that, approximately $235 million is insured. The insurance companies face a crisis unprecedented in the industry's history. Claims pour in by the thousands. property owners present their policies, documenting their losses, demanding payment. The total claims dwarf anything the industry has faced before. No single fire, no single maritime disaster, no accumulation of ordinary losses has ever approached this magnitude. The companies respond differently. Some, particularly British companies with substantial capital and reputations to maintain, commit immediately to paying all valid claims. The Norwich Union, a British fire insurer, instructs its agents in San Francisco to pay claims promptly and fairly. The company will honour its obligations regardless of the cost. This decision costs Norwich Union approximately £3 million but preserves its reputation. Policyholders in San Francisco and worldwide see that Norwich Union keeps its promises even under catastrophic circumstances. Other companies attempt to avoid payment. They examine their policies and notice that most fire insurance policies contain exclusion clauses for earthquake damage. The policies cover fire, but specifically exclude damage caused by earthquakes. The question becomes, did the San Francisco buildings burn because of the earthquake, or because of fires that happened to occur after an earthquake? For many buildings, this distinction is meaningful. Some structures survived the earthquake intact but burned in the subsequent fires. These claims seem clearly covered. The fire caused the loss, not the earthquake. But other buildings were damaged by the earthquake and then burned. Did the earthquake damage cause the loss, or did the fire? The insurance companies that seek to minimize their losses argue that the earthquake was the proximate cause, that the fires would not have occurred without the earthquake, that the damage is therefore excluded. The legal battles over this continue for years. Some companies pay substantial claims but far less than the full insured value, arguing that part of the damage was earthquake-related and therefore excluded. Some companies pay nothing, forcing policyholders to sue. The courts generally side with policyholders, finding that fire insurance should cover fire damage regardless of what caused the fire to start. But the litigation is slow and expensive. The industry learns from San Francisco. The catastrophe demonstrates that geographic concentration of risk is dangerous. An insurance company that writes most of its policies in a single city faces the possibility that one event will generate simultaneous claims across its entire portfolio. The solution is diversification, spreading risks across multiple cities and regions, ensuring that no single catastrophe can destroy the company. Reinsurance becomes essential. After San Francisco, primary insurance companies routinely purchase reinsurance to protect against catastrophic losses. The reinsurers, operating globally, can absorb concentrations of risk from individual cities because they insure cities across multiple continents. A reinsurer covering San Francisco also covers London and Berlin and Tokyo. The probability that all face catastrophes simultaneously is negligible. The catastrophe also demonstrates the limits of insurance for certain types of events. Earthquake insurance largely disappears after San Francisco. The insurance companies conclude that earthquake risk cannot be reliably priced, that the concentration of potential losses is too severe, that they will not offer coverage for this peril. California property owners find themselves unable to purchase earthquake insurance at any price. The private insurance market has decided this risk is uninsurable. The exclusion of earthquake coverage creates problems that persist for decades. Property owners in earthquake-prone regions face enormous uninsured risk. The eventual solution, developed in the late 20th century, involves government-backed insurance programs that provide catastrophe coverage the private market will not offer. But in 1906 and for decades after, the lesson is clear. Insurance has limits. Some risks are too concentrated, too catastrophic, too unpredictable to be managed through private insurance mechanisms. 6 years later, April 15th, 1912. The North Atlantic, approximately 400 miles south of Newfoundland. The Titanic, the largest passenger ship ever built, strikes an iceberg at 23 minutes before midnight. The collision tears the hull open below the waterline. Water floods the forward compartments. The ship, deemed unsinkable by its builders and by the popular press, begins sinking. There are not enough lifeboats for all passengers and crew. The ship's designers and the regulatory authorities had assumed that lifeboats were primarily for transferring passengers to rescue ships, that the ship itself was so safe that everyone abandoning it simultaneously was unnecessary to plan for. This assumption proves fatal. As the ship sinks bow first into the icy water, more than 1,500 people die. Passengers who could not board the insufficient lifeboats, crew members who stayed at their posts, musicians who continued playing to calm the passengers, wireless operators who sent distress signals until the electrical system failed. The insurance implications are substantial. The ship itself was insured for approximately $5 million, split among multiple underwriters at Lloyd's and among various insurance companies. The cargo was separately insured: mail, personal effects, and commercial goods being transported across the Atlantic. And many of the wealthier passengers carried life insurance policies, some for very large sums. A first-class passenger might carry a life insurance policy for $50,000 or $100,000, substantial coverage for the time. The total insured loss from Titanic approaches $9 million. This is enormous, but not overwhelming for the global insurance industry. The claims are distributed across many insurers. Lloyd's underwriters who had accepted portions of the hull insurance pay their shares. Life insurance companies honour policies on passengers who died. The losses are significant, but manageable. But Titanic affects insurance in ways beyond the immediate claims. The disaster generates demands for improved maritime safety regulation. The inadequate lifeboat requirements are revised. Radio equipment becomes mandatory on passenger ships. Ice patrols are established in the North Atlantic to warn ships of iceberg dangers. These safety improvements reduce future maritime risks, eventually lowering insurance premiums as ships become safer. The insurance industry also revises its assumptions about risk. Titanic demonstrated that even the newest, most advanced technology can fail catastrophically. The assumption that modern ships are essentially safe proves wrong. The underwriters at Lloyd's adjust their premium rates for passenger ships, recognizing that catastrophic loss remains possible regardless of the vessel's presumed quality. Life insurance companies face questions about whether deaths in maritime disasters should be treated differently from ordinary deaths. Some policies contain exclusion clauses for deaths in war or in unusually hazardous activities. Does travelling on a supposedly safe passenger ship count as hazardous? The industry generally concludes that it does not, that life insurance should cover death regardless of cause except for specifically excluded perils like suicide or war. The Titanic policies are paid without contest. August 1914. The Great War begins in Europe. What starts as a regional conflict between Austria-Hungary and Serbia escalates within weeks into a continental war involving Germany, Russia, France, and Britain. By 1918, the war will have killed 17 million people and wounded 20 million more, will have consumed the wealth of empires, will have transformed European society and politics in ways that will shape the entire 20th century. For insurance, the war creates immediate crisis. Marine insurance faces unprecedented danger. German U-boats begin attacking Allied merchant shipping, sinking vessels carrying goods to Britain and France. The traditional assumption that most ships complete their voyages safely becomes invalid. In the war zones, particularly in the waters around Britain, loss rates reach 20 or 30% or even higher during the worst periods. Lloyd's underwriters initially attempt to price this risk through higher premiums. War risk insurance becomes a separate category, with premiums reflecting the elevated danger. But as losses mount, some underwriters withdraw from the market entirely, concluding that the risk cannot be adequately priced. The British government eventually establishes a government war risk insurance programme, offering coverage that private insurers will not provide, charging premiums that reflect partial subsidy from government funds. Life insurance faces different challenges. Many policies contain war exclusion clauses, stating that death in military service is not covered. This made sense for peacetime policies sold to civilians who are not expected to face military danger. But with mass conscription, millions of policyholders suddenly face combat. The insurance companies enforce their war exclusion strictly. Families of soldiers killed in battle find their life insurance claims denied. This generates enormous public anger. The families argue that their loved ones were conscripted involuntarily, that they did not choose to enter military service, that the insurance should still cover them. The insurance companies respond that war creates fundamentally different risk, that they cannot price policies to cover combat deaths, that the exclusion clauses were clear when the policies were purchased. Some insurance companies, responding to public pressure and to reputational concerns, agree to pay reduced claims on policies with war exclusions. A policy that would have paid £1,000 for ordinary death might pay £500 for combat death. Other companies pay nothing, standing on their contractual rights. The industry's reputation suffers significantly from the perception that insurers are profiting by denying claims to families of war dead. After the war, most insurance companies remove or modify war exclusion clauses, recognizing that future conflicts might again involve mass conscription, that excluding war deaths creates public relations disasters that outweigh the financial savings. The policies issued after 1918 typically cover death from any cause, with premiums priced to account for the low but non-zero probability of future wars. The war also disrupts insurance company investments. Life insurers had invested their reserves heavily in government bonds, assuming these were the safest possible investments. But the war brings inflation and currency instability. German insurance companies holding German government bonds find their investments destroyed by hyperinflation in the early 1920s. British and French insurers fare better, but still face significant investment losses from bonds that depreciate in real value due to inflation. 1918 brings another catastrophe, different in kind from earthquake or shipwreck or war, but equally devastating in its impact. The influenza pandemic begins in the spring, spreads globally by autumn, kills with terrifying speed and unpredictability. Unlike most influenza strains, which kill primarily the very young and the very old, the 1918 flu kills healthy young adults. A person might feel fine in the morning and be dead by evening. The mortality is concentrated among people in their 20s and 30s, precisely the age group most likely to carry life insurance. the pandemic kills approximately 50 million people globally, including perhaps 675,000 in the United States alone. The life insurance companies face enormous claims. An insurer expecting to pay claims on perhaps 2% of its policyholders in a normal year might face claims on 5 or 6% during the pandemic. The claims concentrate in the final months of 1918, creating cash flow crises as companies must pay out far more than expected in a short period. The companies respond by drawing down reserves, by selling investments to raise cash, by using their reinsurance arrangements to share the losses. Most companies survive the pandemic, though some smaller insurers fail or are absorbed by stronger companies. The industry as a whole demonstrates resilience. The diversification across geographic regions helps, because while the pandemic is global, it strikes different areas at different times. The company's conservative investment practices mean they have liquid assets available to meet claims. But the pandemic affects insurance pricing for years afterward. Life insurance premiums increase as companies factor in the possibility of future pandemics. Some insurers add pandemic exclusion clauses to new policies, though these prove difficult to enforce and eventually are abandoned. The actuarial profession studies the pandemic, attempting to understand whether it was a unique event or whether similar mortality spikes should be expected periodically. The catastrophes of the early 20th century, San Francisco Titanic, the Great War, the influenza pandemic, transform insurance in several ways. The industry learns that catastrophic risk is real, that events can generate losses far exceeding normal expectations, that geographic concentration is dangerous, that diversification and reinsurance are essential. The industry also learns that some risks cannot be privately insured. Earthquake insurance largely disappears. War risk insurance requires government backing. The private insurance market has boundaries beyond which it cannot or will not venture. This creates policy questions about how society should handle risks that are too large or too concentrated for private insurance to cover. Regulation intensifies in response to the catastrophes. Governments require insurance companies to maintain larger reserves, to diversify their risks, to purchase reinsurance. The goal is to prevent company failures that would leave policyholders without coverage. Some companies fail despite regulation, particularly smaller insurers that lacked adequate capital. But the major companies survive, demonstrating that well-capitalized insurers with diversified risks can withstand even catastrophic loss events. The catastrophes also strengthen public perception that insurance is essential. San Francisco property owners who had insurance rebuild. Those who did not often cannot. Families who had life insurance when the breadwinner dies in the pandemic survive financially. Those who did not often face destitution. Insurance increasingly seems not optional but necessary, a basic element of financial planning that prudent people maintain. The industry emerges from this period of testing larger and more sophisticated, but also humbled. The confidence of the late 19th century, the sense that insurance could protect against any risk, that mathematical pricing could manage any uncertainty, gives way to recognition of limits. Some risks are too large, some events too catastrophic, some losses too concentrated. Insurance works remarkably well for ordinary risks. For the scattered individual losses that occur constantly but predictably, it struggles with extraordinary risks, with the concentrated catastrophic events that violate the assumptions underlying insurance mathematics. The response is not to abandon insurance, but to refine it, to acknowledge its boundaries while strengthening its core functions. Reinsurance becomes standard practice. Capital requirements increase. Geographic diversification becomes mandatory rather than optional. Catastrophe planning becomes part of insurance company management. The industry learns to expect the unexpected, to hold reserves for events it cannot precisely predict, to build resilience into its structures. By the 1920s, insurance has matured through crisis. The companies that survived are stronger, more cautious, more realistic about risk. The regulatory frameworks are more robust. The professional practices, actuarial science, risk management, investment management, are more sophisticated. The system works, not perfectly but adequately, providing protection for millions while acknowledging that some risks exceed what private insurance can manage. The catastrophes recede into history, becoming case studies for actuaries, lessons for risk managers, stories of resilience for the industry. San Francisco rebuilds, its buildings now more resistant to earthquake and fire. The Titanic becomes symbol of technological hubris, its loss remembered but no longer shocking. The Great War ends, the influenza pandemic fades, normal life resumes, and insurance returns to its patient work, collecting premiums, paying claims, accumulating reserves, investing carefully, managing risk. The extraordinary events test the system, but the ordinary events are where insurance spends most of its time. The individual deaths, the individual fires, the individual accidents that occur constantly across the millions of policies in force, each one a small tragedy for those involved, each one a routine claim for the insurance company, the many protecting the few, day after day, year after year, the system functioning as designed, making modern life more secure, more predictable, more manageable, despite the uncertainties that always threaten. The catastrophes proved that insurance could endure stress. The question was whether it could continue adapting to a world growing more complex, more interconnected, more dependent on technologies and systems that created new types of risk. That adaptation would be the work of the rest of the 20th century. The patient evolution of insurance from an industry that protected ships and buildings and lives into one that would eventually touch almost every aspect of modern economic existence. The catastrophes had tested insurance and found it resilient but limited. The industry entered the decades after the Great War chastened but functional, aware of its boundaries but confident within them. What followed was not dramatic crisis but gradual transformation, the patient expansion of insurance into domains that earlier generations had not imagined insurable, the adaptation to technologies and economic structures that created new risks and new possibilities. The automobile transformed insurance perhaps more than any other single technology. In 1900, automobiles were rare curiosities, expensive toys for the wealthy, unreliable machines that broke down frequently and required specialist knowledge to operate. By 1930, automobiles were becoming mass-market products, millions of them on roads across America and Europe, driven by ordinary people with varying levels of skill and judgment. The early automobiles were slow and few enough that accidents were relatively rare. But as speeds increased and as the number of vehicles grew, collisions became common. An automobile accident could kill or injure the driver, passengers and pedestrians. It could damage both vehicles involved. It could damage property, fences, buildings, streetlights. The financial liability from a serious accident could be substantial, potentially ruining the driver who was at fault. automobile insurance emerged to address these risks. The first policies covered damage to the insured vehicle itself. If you crashed your car, the insurance would pay for repairs. This was property insurance, similar to fire insurance for buildings, priced based on the vehicle's value and the driver's perceived risk level. A young male driver paid higher premiums than a middle-aged woman, reflecting the statistical reality that young men had more accidents. But the more significant development was liability insurance, coverage that paid damages to others if the insured driver caused an accident. This protected the driver from financial ruin if he injured someone or destroyed someone's property. The liability coverage might pay for medical expenses, for damaged property, for legal costs if the injured party sued. The pricing of automobile insurance required new actuarial thinking. Life insurance premiums could be calculated from mortality tables. Fire insurance premiums could be based on building characteristics and location. But automobile accident risk depended on the individual driver's behavior, on road conditions, on traffic density, on countless factors that varied from moment to moment. The insurers had to develop statistical models that categorize drivers by risk factors, age, sex, driving record, location, and charge premiums accordingly. By the 1930s, automobile insurance was common in the United States, required by some states for all drivers, strongly recommended everywhere. The premiums were modest for safe drivers, perhaps $20 to $40 annually for basic coverage, but they could be much higher for young or risky drivers. The insurance became part of the cost of automobile ownership, factored into whether one could afford to purchase and operate a vehicle. The expansion of automobile insurance created the first truly mass-market insurance product. Life insurance had reached the middle class but remained too expensive for many working-class families. Fire insurance covered property owners but not renters. But automobile insurance, once driving became widespread, touched millions of ordinary people. The insurance companies had to develop systems for handling huge volumes of small policies, for processing thousands of claims monthly, for managing millions of premium payments. This drove administrative innovation. Insurance companies adopted filing systems, developed standardized forms, created procedures for claims handling that could be taught to ordinary clerks. The actuarial work became more sophisticated. Statistical analysis of accident rates, regression models to predict claims frequency, classification systems that divided drivers into risk categories. The industry was becoming more scientific, more systematic, less dependent on individual judgment, and more on mathematical models. The 1930s brought economic depression that tested insurance differently than catastrophes had. The Great Depression did not generate sudden, massive claims. It created gradual financial stress as policyholders struggled to maintain their coverage, as investment returns collapsed, as the economic foundation supporting the insurance system eroded. Life insurance policyholders faced difficult choices. Should they continue paying premiums when money was scarce and unemployment was high? Many allowed policies to lapse, sacrificing future protection for immediate financial relief. The lapse rate soared, reaching 50 or 60% at some companies. The insurers lost premium revenue, but also avoided future claims on the lapsed policies, creating complicated financial effects. The insurance companies' investments suffered significantly. The conservative bond portfolios that had seemed prudent lost value as interest rates fell and as some corporate and municipal borrowers defaulted. Real estate investments, mortgages on commercial and residential property, became troubled as property values collapsed and borrowers could not pay. Some insurance companies failed, unable to maintain solvency as their assets depreciated. But most major insurers survived the depression through conservative management and through the reserves they had accumulated. The regulatory requirements for reserve maintenance, tightened after earlier failures, meant that insurers had buffers to absorb investment losses. The diversification across many policyholders meant that even high lapse rates did not eliminate premium income entirely. The system bent under the economic stress but did not break. The Depression did transform how people thought about insurance and economic security more broadly. The massive unemployment and financial distress demonstrated that individual prudence and private insurance were not adequate to protect everyone against economic catastrophe. This led to government social insurance programs. Social Security in the United States, established in 1935, provided government-funded retirement and disability benefits, financed through payroll taxes. Social Security was insurance in principle, many people contributing to protect each against poverty in old age or disability, but implemented through government rather than private companies. The distinction between private insurance and social insurance became central to debates about economic policy. What should be left to private markets and individual choice? What should be guaranteed by government? The questions persist unresolved. But the Depression shifted the balance toward greater government role in providing economic security. The Second World War brought challenges similar to but larger than the Great War. Marine insurance again faced elevated risks from submarine warfare and from naval battles. Life insurance again confronted war deaths on massive scale, though insurers had learned from the Great War and generally covered military service deaths, pricing policies to account for war risk. The war also created new insurance needs. The massive industrial production supporting the war effort, factories running 24 hours daily producing weapons and vehicles and supplies, created workplace accident risks on unprecedented scale. Workers' compensation insurance, which covered employees injured on the job, expanded enormously. The premiums collected funded benefits for hundreds of thousands of injured workers. Aircraft insurance became significant during and after the war. Before the war, aviation insurance was a small specialty market covering the handful of commercial airlines and private aircraft owners. The war demonstrated that aircraft could carry passengers safely over long distances if properly designed and maintained. After the war, commercial aviation expanded rapidly. The airlines needed insurance covering the aircraft themselves, expensive machines worth hundreds of thousands of dollars each, and liability insurance covering passengers and people on the ground. Aircraft insurance required specialized expertise. The risks were different from maritime or automobile risks. Accidents were rare but often catastrophic, killing everyone aboard and potentially people on the ground. The insurers had to price coverage for these low-frequency, high-severity events, developing models that accounted for aircraft type, pilot experience, route safety, weather conditions. The post-war period, from the late 1940s through the 1960s, brought sustained economic growth in the developed world and corresponding insurance expansion. As people became wealthier, they purchased more insurance. Life insurance coverage increased. The average policy face amount rose from perhaps $2,000 in the 1940s to $10,000 or $20,000 by the 1960s. home ownership expanded dramatically, and with it homeowners' insurance covering houses and contents against fire and theft and other perils. Health insurance emerged as major insurance category in the post-war period. Before the war, health insurance was rare. People paid for medical care directly, or they went without care if they could not afford it. But medical costs were rising as treatments became more sophisticated and as hospital care became standard. The expense of serious illness could bankrupt a family. Employer-based health insurance developed in the United States during the war as a way for employers to attract workers without violating wartime wage controls. After the war, the practice continued and expanded. By the 1960s, most American workers with full-time employment had health insurance provided by their employers, with premiums shared between employer and employee. The health insurance structure created complex incentive problems. The insured person did not pay directly for medical care, the insurance company paid. This meant consumers had little incentive to limit care or to shop for lower prices. Doctors and hospitals had incentive to provide more care, more tests, more procedures, because insurance would pay. The result was rapidly increasing medical costs, far outpacing general inflation. The health insurers attempted to control costs through various mechanisms, requiring pre-approval for expensive procedures, negotiating fee schedules with doctors and hospitals, limiting coverage to necessary rather than optional care. But the fundamental problem persisted. Health insurance separated the person receiving care from the person paying for it, creating moral hazard that was difficult to manage. By the 1960s and 70s, health insurance costs were rising at 10 or 15% annually, double or triple the general inflation rate. The premiums increased correspondingly. Employers and employees both faced rising costs. The sustainability of the employer-based health insurance system became questionable, a problem that would intensify in subsequent decades. The insurance industry itself was consolidating during this period. The hundreds of small insurance companies that had existed in the early 1900s were merging into larger entities. The economies of scale in insurance were substantial. A larger company could spread fixed costs across more policies, could negotiate better terms with reinsurers, could invest more in technology and in actuarial analysis. By the 1970s, the insurance industry in most developed countries was dominated by a few dozen large companies, each with millions of policyholders and billions of dollars in assets. These companies were among the largest financial institutions, comparable to major banks in their economic importance. The technology revolution transformed insurance operations from the 1960s onward. Computers allowed insurers to manage millions of policies that would have been impossible with paper records and manual processing. An insurance company in the 1950s maintained vast filing systems, rooms full of cabinets holding paper records for each policyholder, clerks updating records by hand. By the 1970s, the records were increasingly digital, stored on magnetic tape and disk, accessible from computer terminals. The computerization reduced administrative costs dramatically. Tasks that had required teams of clerks, calculating reserves, updating policies, processing premium payments, generating renewal notices, could now be performed automatically. The cost savings allowed insurers to offer coverage more cheaply and to manage more policies without proportional increase in staff. Computers also improved actuarial analysis. Statistical models that would have been impossibly tedious to calculate by hand could now be computed quickly. Insurers could analyze claims data in detail, identifying patterns, refining risk classifications, improving pricing accuracy. The models became more sophisticated, incorporating more variables, producing more precise premium calculations. By the 1980s and 90s, insurance companies were investing heavily in information technology. Automated underwriting systems evaluated applications and determined premium rates without human judgment for standard cases. Claims processing systems guided adjusters through investigation and payment procedures. Customer service systems allowed representatives to access policyholder information instantly by telephone. New insurance products emerged to cover risks that earlier generations had not faced. Professional liability insurance protected doctors and lawyers and accountants and engineers against malpractice claims. Directors and officers, insurance protected corporate executives against lawsuits claiming mismanagement. Product liability insurance protected manufacturers against claims that their products caused injury. Environmental liability insurance covered cleanup costs for pollution. Each new product required developing expertise in that risk category, understanding what caused losses, how to prevent them, how to price coverage. The insurance industry accumulated specialized knowledge across an ever-expanding range of risks, becoming the repository of understanding about how things go wrong across modern economic life. The globalization of insurance accelerated through the late 20th century. Large insurers operated across multiple countries, writing policies worldwide, managing risks that crossed borders. Reinsurance became truly global, with reinsurers accepting risks from every continent, diversifying exposure across the entire world. This globalization allowed more efficient risk sharing. A catastrophe in one region could be partially absorbed by premium income from other regions. The Japanese insurers covering earthquake risk in Tokyo could reinsure with European companies, transferring some risk to entities that had no direct exposure to Japanese earthquakes. The global reinsurance market created the broadest possible risk pool, approaching the theoretical ideal of spreading each individual risk across the maximum number of risk bearers. But globalization also created new vulnerabilities. The major insurance companies became interconnected through reinsurance contracts, through shared ownership of assets, through business relationships. A crisis affecting one major insurer could cascade to others through these connections. The system was more efficient but also more systemically fragile. The securitization of insurance risk began in the 1990s, creating new tools for transferring risk from insurers to capital markets. Catastrophe bonds, securities that paid high interest to investors but that could lose principal if specified catastrophes occurred, allowed insurers to transfer catastrophic risk to bond investors. The investors received high returns in normal years, compensating them for the risk that extraordinary events would reduce or eliminate their investment. The catastrophe bond market grew to tens of billions of dollars by the early 21st century. This represented significant additional capacity beyond traditional reinsurance, allowing primary insurers to transfer more risk than reinsurance markets alone could absorb. The innovation demonstrated insurance industry's continuing adaptation, finding new mechanisms to manage risks that grew along with economic development. The insurance industry by the end of the 20th century was vastly larger and more sophisticated than anything previous centuries had known. The global insurance premiums exceeded $1 trillion annually by the late 1990s, perhaps $2 trillion if you included all forms of insurance worldwide. The industry employed millions of people globally. Actuaries and underwriters and claims adjusters and agents and administrators and programmers. The insurance companies managed assets worth trillions of dollars, invested in government bonds and corporate securities and real estate and infrastructure. These investments funded economic development, channeling the accumulated premiums from millions of policyholders into productive uses. The life insurers were particularly significant investors, their long-term obligations matching well with long-term investments in projects requiring patient capital. Insurance had become essential infrastructure for modern economic life. You could not legally drive without automobile insurance in most jurisdictions. You could not get a mortgage without homeowners insurance. Employers were required to maintain workers' compensation insurance. Professionals could not practice without malpractice insurance. The web of insurance requirements and insurance protections was woven through every aspect of economic activity. But the expansion and the sophistication and the globalization had also created complexity that few people fully understood. The insurance company you purchased a policy from might reinsure the risk with another company, which might securitize it through catastrophe bonds purchased by investment funds. Your automobile insurance premium might ultimately be funding German pension benefits through a chain of financial transactions too complex to trace. This complexity made the system more efficient but also more opaque. Regulators struggled to understand and oversee institutions whose operations spanned multiple countries and multiple types of financial activity. The industry had grown beyond the small coffeehouse operations of the 17th century, beyond the personal relationships and community trust that had originally supported insurance, into vast bureaucratic systems operating globally through computer networks. The question was whether this complexity remained manageable, whether the systems that had been designed to spread risk had themselves become sources of risk through their interconnection and their opacity. That question would be answered in the early 21st century, when the global financial system would face crisis that revealed how interconnected and how fragile modern insurance had become. But before that crisis, through most of the late 20th century, insurance functioned remarkably well. Premiums were collected, claims were paid, the system worked. Millions of people faced the future with less fear because insurance protected them against catastrophic loss. The patient arithmetic of pooling risk, collecting premiums, investing carefully, paying claims, all of this continued day after day, year after year, largely invisible to most people but essential to the functioning of modern economic life. The promise that had been written on parchment in 1750 had expanded beyond anything those early underwriters could have imagined. Not just ships and buildings and lives, but automobiles and health and professional liability and environmental cleanup and countless other risks, all managed through the accumulated mechanisms and knowledge of an industry that had learned, slowly and patiently across centuries, how to make uncertainty bearable through collective action and careful calculation. The insurance industry had grown comfortable with its understanding of risk by the late 20th century. The mathematical model seemed robust, the diversification adequate, the regulatory framework sound. The catastrophes of the early 1900s had taught important lessons about concentration risk and about the need for reinsurance. The steady expansion through the mid-century had demonstrated that insurance could scale to serve mass markets. The technology investments had created efficiency. The system worked. Then the system faced tests that revealed limitations no one had fully anticipated. August 24th, 1992. Hurricane Andrew forms over the Atlantic, strengthens as it moves west, strikes southern Florida as a Category 5 storm with wind speeds exceeding 160 miles per hour. The hurricane cuts a path of destruction through Homestead and surrounding areas, destroying or severely damaging more than 63,000 homes, leaving approximately 175,000 people homeless. The property damage totals approximately $26 billion. Of this, roughly $15.5 billion is insured. Claims on homeowners' insurance policies, on business property insurance, on automobile insurance for vehicles destroyed by wind and flooding. The insured losses exceed any previous natural disaster in American history. The insurance industry faces what seems at first like a manageable challenge. $15.5 billion in claims is substantial, but not impossible. The industry's total capital exceeds $100 billion. The losses from Hurricane Andrew represent perhaps 15% of industry capital, significant but survivable. But the losses concentrate in particular companies that had written large amounts of coverage in southern Florida. Some smaller insurers that focused heavily on the Florida market face claims that exceed their total capital. They become insolvent. Policyholders who thought they had protection discover their insurance company no longer exists, that they will receive only partial payment from state guarantee funds established to cover failed insurers. 11 insurance companies fail completely following Hurricane Andrew. The policyholders of these failed companies ultimately receive compensation from state guarantee funds, but the process takes years, and the payments are sometimes less than the policy limits. A homeowner who had purchased $200,000 of coverage might receive $150,000 from the guarantee fund, leaving a $50,000 gap that represents their uninsured loss. The surviving insurance companies face enormous claims processing challenges. 60,000 claims need to be evaluated, damage assessed, settlements calculated, payments made. The insurers deploy thousands of adjusters to the affected area, inspecting damaged properties, documenting losses, negotiating with policyholders. The process overwhelms normal procedures. Some claims take months to settle. Some policyholders wait a year or more for full payment. The reinsurance industry also faces crisis. Many of the primary insurers had purchased reinsurance to protect against catastrophic losses. The reinsurers now face their own claims, billions of dollars in obligations to the primary companies. Some reinsurers, particularly smaller ones that had concentrated their exposure in Florida, become insolvent. The remaining reinsurers pay claims but then sharply increase their premium rates for future coverage. This creates a reinsurance crisis that extends beyond Florida, beyond hurricanes, affecting insurance markets globally. Reinsurance that had cost primary insurers perhaps 8 or 10% of premiums before Andrew now costs 20 or 30%. The primary insurers must raise their own premiums to cover the increased reinsurance costs. Homeowners insurance in Florida becomes dramatically more expensive. Some insurers withdraw from the Florida market entirely, concluding that hurricane risk cannot be adequately priced. The Florida state government eventually creates a state-run insurance program to provide coverage that private insurers will not offer. This government program, called Citizens Property Insurance Corporation, becomes one of the largest property insurers in Florida. covering hundreds of thousands of homes that cannot find private insurance. The premiums charged by citizens are often below what actuarial analysis suggests is adequate, meaning the program operates with implicit government subsidy and risk. Hurricane Andrew teaches the insurance industry several uncomfortable lessons. First, that catastrophe models based on historical data may underestimate future losses. The models used before Andrew had suggested that a major hurricane striking a densely populated area would cause perhaps $5 or $8 billion in insured damage. Andrew's $15.5 billion exceeded these projections by large margins. Second, that geographic concentration of risk is more dangerous than previously understood. The insurers that failed after Andrew had known they were exposed to hurricane risk in Florida. They had purchased reinsurance. They had maintained capital reserves. But the concentration of their policies in a single geographic area meant that one event destroyed them. The lesson was that diversification needed to be even broader, that no insurer should have more than a small fraction of its exposure in any single catastrophe-prone region. Third, that climate and weather patterns might be changing in ways that made historical data less reliable for predicting future losses. Some scientists argued that global warming would increase hurricane frequency or intensity, that the storms of the future would be worse than the storms of the past. The insurance industry faced the possibility that risk was non-stationary, that the probabilities were shifting over time, that the models needed to incorporate climate change projections rather than simply extrapolating from historical experience. The industry responded by developing more sophisticated catastrophe models. These models use detailed data about property locations and construction types, combined with meteorological models of hurricane behavior to simulate thousands of possible storms and calculate potential losses from each. The model suggested that even worse hurricanes than Andrew were possible, that losses could reach $30 or $40 billion from a single storm striking a major metropolitan area. The catastrophe modelling became standard practice for insurers writing property coverage in hurricane-prone or earthquake-prone regions. The models informed decisions about pricing, about how much coverage to write in particular areas, about how much reinsurance to purchase. The insurance industry became more scientific in its approach to catastrophic risk, less reliant on intuition and more on computational simulation. But the models had limitations. They could simulate hurricanes but not predict when the next major hurricane would occur. They could estimate potential losses but not eliminate uncertainty. The fundamental challenge remained. Catastrophic risk involves low-frequency, high-severity events that are difficult to price accurately because decades might pass between major occurrences. September 11th, 2001. Terrorists hijack 4 commercial aircraft, fly 2 into the World Trade Center towers in New York, 1 into the Pentagon in Washington, and 1 crashes in Pennsylvania after passengers resist the hijackers. The World Trade Center towers collapse, killing nearly 3,000 people, destroying the towers and surrounding buildings, creating damage that extends across lower Manhattan. The insured losses from September 11th ultimately exceed $40 billion, making it the largest insured loss event in history to that point. The losses come from multiple types of insurance. Property insurance covers the destroyed buildings, the World Trade Center towers, surrounding structures, damaged properties across lower Manhattan. Business interruption insurance covers the lost income for businesses that cannot operate because their premises were destroyed or damaged. Life insurance covers the nearly 3,000 people killed. Aviation insurance covers the destroyed aircraft. Liability insurance covers the airlines and the building owners against lawsuits from victims' families. Workers' compensation insurance covers employees killed or injured on the job. The losses concentrate in particular insurance companies that had written large amounts of coverage in Lower Manhattan. But the losses also spread across the global reinsurance industry because the primary insurers had reinsured their exposures. Reinsurance companies from Germany, Switzerland, Bermuda, and elsewhere face billions of dollars in claims. The insurance industry pays the claims. Unlike after San Francisco, where some companies contested coverage, the September 11th claims are honored largely without dispute. The industry demonstrates that it can absorb even a $40 billion loss, that the system is resilient, that the promises will be kept. But September 11th transforms how insurance thinks about terrorism risk. Before the attacks, terrorism coverage was typically included in standard property and casualty policies, without specific exclusion or specific charge. The assumption was that terrorism events were rare and small scale, that the losses would be minor, that explicit terrorism coverage was unnecessary. After September 11th, insurers immediately exclude terrorism from standard policies or charge substantial additional premiums for terrorism coverage. The reinsurers also exclude terrorism or charge prohibitive rates. The result is that terrorism coverage largely disappears from private insurance markets. Building owners in major cities cannot purchase terrorism insurance at any reasonable price. This creates economic problems. Lenders require insurance as condition for mortgages. If property owners cannot get terrorism insurance, they cannot get financing for new construction or for refinancing existing properties. The commercial real estate market in major cities faces potential paralysis. The United States government responds by creating the Terrorism Risk Insurance Act in 2002. This establishes a government backstop for terrorism losses. Private insurers agree to offer terrorism coverage at regulated rates. If losses from a terrorism event exceed certain thresholds, the federal government will cover a large portion of the losses, with insurers and policyholders covering the remainder. This government intervention makes terrorism insurance available again, preventing the real estate market disruption. The terrorism insurance program demonstrates again that some risks are too large or too concentrated for private insurance markets to cover without government support. The September 11th losses were manageable for the industry, but the theoretical possibility of much larger terrorism events, biological or chemical or nuclear attacks that could kill hundreds of thousands, exceeded what private capital could absorb. Government had to act as insurer of last resort for risks that threatened the entire economy. The global financial crisis of 2008 brings different challenges. The crisis begins in mortgage markets, spreads to banks and investment firms, threatens the entire financial system. Insurance companies are affected through their investments and through their connections to the banking system. The crisis particularly affects one company, American International Group, known as AIG. AIG had been one of the largest insurance companies globally, operating in dozens of countries, writing every major type of insurance, managing hundreds of billions of dollars in assets. But AIG had also created a financial products division that sold credit default swaps, essentially insurance on bonds, promising to pay if bonds defaulted. The credit default swap seemed profitable. AIG collected premiums for insuring bonds, particularly mortgage-backed securities, against default. As long as the bonds did not default, AIG kept the premiums without having to pay claims. The division appeared to generate enormous profits with little risk. But the mortgage crisis changed everything. The mortgage-backed securities that AIG had insured began defaulting in large numbers. AIG faced claims potentially totaling hundreds of billions of dollars, far more than the company had in capital, far more than traditional insurance operations could possibly generate. The company faced bankruptcy. The federal government intervened, providing AIG with $182 billion in loans and capital injections, effectively nationalizing the company to prevent its collapse. The government justified this intervention by arguing that AIG's failure would cascade through the financial system, that the company was systemically important, that its collapse would worsen the financial crisis. The AIG rescue troubled many observers. The company had engaged in activities that looked like insurance. Credit default swaps were called swaps, but functioned like insurance, but that were not regulated as insurance. The financial products division had operated without the reserve requirements, the capital requirements, the regulatory oversight that traditional insurance companies faced. It had taken enormous risks using other people's money, the capital from AIG's traditional insurance operations, and when those risks materialized, the government had to rescue it. The episode raised fundamental questions about what insurance is and what it should be allowed to do. Should insurance companies be permitted to engage in financial activities beyond traditional insurance? Should activities that function like insurance be regulated as insurance even if they are called something else? How do you prevent insurance companies from becoming systemically important institutions whose failure threatens the entire financial system? The regulatory response came through the Dodd-Frank Act of 2010, which designated certain large insurance companies as systemically important financial institutions subject to enhanced oversight. The goal was to prevent future AIG-type situations where insurance companies took risks that threatened the broader economy. But the AIG crisis also demonstrated something about the limits of regulation. The company had been regulated. Its traditional insurance operations were overseen by state insurance commissioners, but the financial products division had operated largely outside this oversight, exploiting a gap in the regulatory framework. No regulator had full visibility into AIG's total risk exposure. The lesson was that financial regulation needed to be comprehensive, that gaps could be exploited, that systemically important activities needed oversight regardless of what they were called. Flood insurance poses continuing challenges throughout the late 20th and early 21st centuries. The National Flood Insurance Program, created by the United States government in 1968, provides subsidized flood insurance because private insurers will not adequately cover this risk. The program charges premiums below actuarially fair rates, particularly for properties that were built before flood maps were created. This creates moral hazard. Property owners in flood-prone areas can purchase insurance cheaply, reducing their incentive to avoid building in dangerous locations. When floods occur, the insurance pays to rebuild in the same flood-prone location. The cycle repeats. Some properties have been rebuilt multiple times using flood insurance payments, with the total insurance payments exceeding the property's value. The National Flood Insurance Program accumulates enormous debt, particularly after major hurricanes that cause both wind damage and flooding. Hurricane Katrina in 2005 generates approximately $16 billion in flood insurance claims, far exceeding the program's reserves. The program borrows from the Treasury to pay claims, accumulating debt that reaches $20 billion by the early 2010s. The flood insurance problem illustrates the tension between insurance principles and social policy. Actuarially fair flood insurance would be prohibitively expensive for many properties, making them economically unviable. This would effectively force people to abandon flood-prone areas, but communities and politicians resist this outcome, wanting people to remain in coastal areas and river floodplains despite the flood risk. The result is subsidized insurance that encourages risky behavior and that transfers the cost to taxpayers generally. Climate change adds another dimension to this challenge. Sea levels are rising, coastal flooding is becoming more frequent, hurricane intensity may be increasing. The flood risks that seemed manageable in 1968 appear different in 2020. The National Flood Insurance Program faces questions about whether it can remain sustainable if flood losses continue increasing. The insurance industry more broadly grapples with climate change implications. Property insurers face potentially increasing losses from hurricanes, floods, wildfires, and other weather-related events. The historical data that inform insurance pricing may no longer accurately predict future losses if climate is changing. Some insurers begin incorporating climate projections into their models, adjusting premiums upward in regions where climate change appears to increase risk. But this creates political and social tensions. Raising insurance premiums in coastal areas or in wildfire-prone regions makes those areas less affordable, potentially forcing people to relocate. Communities resist, arguing that insurance is becoming unaffordable. Some states impose rate caps, limiting how much insurers can charge. The insurers respond by withdrawing from those markets, leaving property owners unable to find coverage. California faces particularly acute problems with wildfire insurance. The state experiences increasingly severe wildfire seasons through the 2010s. Insurance companies face billions in claim from fires that destroy thousands of homes. Some insurers withdraw from high-risk areas. Others raise premiums dramatically. The state eventually restricts insurer ability to cancel or non-renew policies, requiring them to continue covering properties even in high-risk areas. This increases insurer losses and leads to further market disruption. The COVID-19 pandemic beginning in 2020 creates yet another insurance crisis. Businesses forced to close due to government lockdown orders file claims under business interruption insurance, arguing that the pandemic and the government response created covered losses. The insurers deny most claims, pointing to policy exclusions for viruses and for government action. The disputes generate thousands of lawsuits, most resolved in favor of insurers but some in favor of policyholders. Life insurers face increased mortality claims as COVID deaths mount. The industry estimates that life insurance claims related to COVID in 2020 and 2021 exceed $100 billion globally. The companies absorb these losses without systemic crisis, demonstrating again that well-capitalized insurers can handle even severe mortality spikes. But the pandemic reveals gaps in coverage. Business interruption insurance generally excludes pandemics. Most individuals lack pandemic-specific coverage. The private insurance market proved inadequate for protecting against a global pandemic's economic effects. Governments had to provide direct financial support, unemployment benefits, business grants, stimulus payments, because insurance did not cover these losses. the question arises whether pandemic risk can or should be insured privately. Some proposals suggest creating pandemic insurance similar to terrorism insurance, with government backstop for extreme scenarios. Others argue that pandemic risk is fundamentally uninsurable privately because losses are too correlated globally, that everyone faces claims simultaneously, that no amount of diversification can spread truly global risks. The challenges facing insurance in the early 21st century are different from the challenges of earlier eras but reflect similar themes. Some risks exceed private insurance capacity and require government involvement. Some risks are changing due to climate or technology or other factors, making historical data less reliable. Some risks are created by the insurance system itself through moral hazard and adverse selection. The patient arithmetic of pooling risk continues to work for ordinary risks, but struggles with extraordinary risks that violate the assumptions underlying insurance mathematics. The industry adapts, as it has always adapted. New catastrophe models are developed. Climate projections are incorporated into pricing. Government programs are created for uninsurable risks. Regulation is enhanced to prevent systemic risks. The system bends under stress but does not break, continues to function even as it faces challenges that test its limits. The promise written on insurance policies is still kept, mostly. Claims are paid, though sometimes after dispute and delay. Coverage is provided, though not for every risk at every price. The many still protect the few through pooled premiums and collective risk-bearing. But the complexity has grown. The challenges have intensified. The limits have become more apparent. Insurance works remarkably well for most purposes, but the easy confidence of earlier eras has given way to recognition that managing uncertainty is harder than it once seemed, that some risks resist reduction to mathematical models, that the future may not resemble the past in ways that make insurance calculations unreliable. Still, the system persists. Premiums are collected, reserves are maintained, claims are paid. The patient work of insurance continues, making modern life possible. Even as the risks grow more complex, the challenges more difficult, the questions about sustainability more pressing. The industry that began with merchants in a coffee house, that grew through catastrophes and depressions and wars and pandemics, that adapted to automobiles and computers and climate change, continues its work, continues trying to make uncertainty bearable through collective action and careful calculation, continues despite everything to keep the promises written in policies across centuries. The patient arithmetic of insurance still functioning, still essential, still imperfect, but still the best mechanism humans have devised for facing an uncertain future together. The crises and adaptations, the expansions and limitations, the catastrophes and responses, all of this history reveals insurance through its evolution, through what it became over centuries. But understanding insurance fully requires returning to fundamentals, to the mathematics and principles that explain why insurance works when it works, and why it fails when it fails. The foundation of all insurance is the law of large numbers. This principle, formalized by mathematicians in the 18th century but understood intuitively much earlier, states that as you observe more instances of a random event, the average outcome converges toward the expected value. Flip a coin 10 times and you might get 7 heads and 3 tails. Flip it 1,000 times and you will get very close to 500 heads and 500 tails. The more observations, the more predictable the average. Apply this to insurance. One person faces uncertain mortality, might die young, might die old, might live 40 years or 80 years, but 1,000 people of the same age will collectively experience mortality very close to the average for that age. Some will die young, others will live long. But the total deaths in a year will be predictable within narrow range. This predictability allows insurance to function. The insurance company cannot know which specific policyholders will die in a given year, but it can predict with reasonable accuracy how many will die. If it insures 1,000 40-year-old men, and mortality tables indicate that approximately 3 per thousand will die each year, then the company can expect roughly 3 deaths annually. Some years might see 2 deaths, some might see 4, but over time, the average will approach 3 per thousand. The company sets premiums to cover these expected deaths, plus administrative expenses, plus profit margin. If each policy covers $10,000 and 3 deaths per thousand are expected, the company needs 3 times 10,000 equals $30,000 per year to pay claims. Spread across 1,000 policyholders, that is $30 per person for pure claim costs. Add administrative expenses and profit, and the premium might be $40 or $50 per person annually. This calculation works because of the law of large numbers. With many policyholders, the actual claims will be close to the expected claims. The company can price policies with confidence that it will collect enough in premiums to pay claims and expenses. Each individual policyholder faces enormous uncertainty. Will I die this year or not? But the company faces much less uncertainty because it pools many individuals. The pooling is essential. An insurance company with 10 policyholders faces much more uncertainty than one with 1,000 policyholders. The company with 10 might see 0 deaths one year and 3 the next. Enormous variation that makes pricing difficult and reserves unpredictable. The company with 1,000 will see deaths close to 3 per thousand every year, making everything more predictable. This is why insurance companies want large numbers of policyholders. It is not merely about profit on more policies, though that matters. It is about reducing uncertainty through pooling. The larger the pool, the more predictable the aggregate outcome, the more confidently the company can price coverage and maintain adequate reserves. But the law of large numbers has a crucial assumption. The insured events must be independent. One person's death should not make another's more likely. One house fire should not cause another. If risks are independent, then pooling reduces uncertainty. If risks are correlated, then pooling may not help at all. Consider earthquake insurance. Houses in the same city face correlated risk. If one experiences earthquake damage, others likely do too because they all sit above the same fault line. Pooling 1,000 houses in San Francisco does not create the same risk reduction as pooling 1,000 randomly distributed houses. An earthquake that damages one house probably damages many. The company might face 0 claims for years, then 1,000 claims simultaneously. This correlation makes earthquake insurance difficult to price and risky to offer. The insurance company would need enormous capital reserves to handle the possibility that all its insured properties suffer damage simultaneously. Or it would need to charge premiums so high that few people would purchase coverage. Either way, the economics become problematic. This explains why some risks are insurable and others are not. Insurable risks should be independent or at least not too highly correlated. Mortality from various causes is mostly independent. One person dying of heart disease does not make another person's heart disease more likely. House fires are mostly independent. One house burning does not ignite distant houses. These risks can be pooled effectively. but pandemic disease is highly correlated globally. War affects many people simultaneously. Economic depression creates unemployment that hits many families at once. Climate change potentially makes all coastal properties face increased flood risk simultaneously. These correlated risks resist insurance because pooling does not reduce uncertainty adequately. The other requirement for insurability is that the risk must be measurable. The insurance company needs to estimate the probability of loss with reasonable accuracy to price coverage appropriately. Life insurance became fully insurable only after mortality tables allowed quantification of death probabilities. Fire insurance required understanding what factors increased fire risk. Automobile insurance required data about accident rates for different driver categories. Some risks cannot be measured with confidence. The probability of a novel technology failing in an unprecedented way is inherently uncertain. The probability of a pandemic starting in any given year is difficult to estimate from limited historical data. The probability of catastrophic climate change effects is uncertain because we have no prior examples of the current situation. These unmeasurable risks pose challenges for insurance because insurers cannot price them accurately. The actuarial profession exists to make risks measurable. Actuaries collect data, build statistical models, calculate probabilities, translate uncertainty into numbers that can inform pricing. The sophistication of actuarial methods has increased dramatically over centuries, from Halley's simple life table to modern computational models that incorporate hundreds of variables. But the fundamental task remains the same: quantify risk so it can be priced. The premium calculation for any insurance follows similar logic. Start with expected losses, the probability of a claim multiplied by the average claim size. Add expenses for administration, marketing, claims handling. Add a profit margin. The total is the premium. Consider automobile insurance for a specific driver. Data might indicate that drivers in his category have a 3% probability of filing a claim in a year, and that the average claim is $4,000. Expected losses are 0.03 times 4,000 equals $120. Administrative expenses might be $30, profit margin might be $20, the premium would be $170. This calculation seems straightforward, but contains enormous complexity. How do you categorize the driver? By age, by sex, by location, by driving record, by vehicle type? There are dozens of potential factors. The insurer builds classification systems that group similar drivers together, creating categories small enough to be relatively homogeneous but large enough to have sufficient data for statistical analysis. The classification creates equity concerns. If young male drivers have higher accident rates, should they pay higher premiums? Economically, this makes sense. They create higher expected losses, but it may seem unfair to charge someone more because of age and sex, characteristics they cannot control. Some jurisdictions prohibit insurance companies from using certain classification factors, requiring them to spread costs more evenly across different groups. When prohibited from pricing risk accurately, insurers face adverse selection. If they must charge the same premium to low-risk and high-risk drivers, the low-risk drivers will find the coverage expensive for their actual risk and may choose not to purchase it. The high-risk drivers will find it a bargain and will definitely purchase coverage. The insurer's pool becomes tilted toward high-risk individuals, and the claims exceed what the premiums were designed to cover. This adverse selection dynamic affects all insurance markets where pricing is restricted, or where insurers have less information than policyholders about risk. Health insurance faces severe adverse selection if healthy people can opt out while sick people must participate. Life insurance faces it if people with knowledge of impending illness can purchase large policies. The only solution is either to price risk accurately, which may be politically unacceptable, or to mandate participation, ensuring that low-risk individuals remain in the pool. Moral hazard, the change in behaviour caused by having insurance, is the other persistent challenge. People with fire insurance may take less care to prevent fires. People with automobile insurance may drive less carefully. People with health insurance may seek more medical care than they would if paying directly. The insurance itself creates the additional risk. Insurers manage moral hazard through various mechanisms. Deductibles require policyholders to pay the first portion of any loss, maintaining incentive to avoid claims. Coinsurance requires policyholders to pay a percentage of claims even after the deductible. Policy limits cap coverage, ensuring that the insured bears some risk of catastrophic loss. These mechanisms imperfectly align insured behaviour with insurer interests. The reserve calculation for insurance companies is fundamental to their solvency and to regulatory oversight. For property and casualty insurance, reserves represent the estimated cost of claims that have occurred but not yet been settled. A car accident happens today, but the claim might take months to investigate and settle. The insurer must reserve funds to pay this claim eventually. The reserve calculation requires estimating both the number of unreported claims and the ultimate cost of known claims. Actuaries use historical data about reporting delays and claim development to estimate these amounts. The estimates are uncertain. Some claims will be larger than expected, others smaller, but they should be accurate on average across many claims. For life insurance, reserves are more complex. The company has promised to pay death benefits potentially decades in the future. It must hold assets sufficient to pay those benefits when they come due. The reserve for each policy is the present value of expected future benefits minus the present value of expected future premiums. This calculation requires assumptions about future mortality, about investment returns, about policyholder behaviour regarding lapsing or continuing coverage. The investment of reserves is crucial to insurance company profitability. Life insurers collect premiums years before paying claims. They invest these premiums conservatively, in government bonds, in high-quality corporate bonds, in mortgages, earning return that supplements premium income. The investment income allows them to charge lower premiums than would be necessary if they simply held cash. The typical life insurer might collect $1 billion in premiums annually and pay $800 million in claims and expenses, leaving $200 million in profit before considering investment income. But they hold $20 billion in reserves invested at perhaps 5% annually, generating $1 billion in investment income. The total profit is $1,200 million, 6 times the underwriting profit. The investment income is essential to the business model. This makes life insurers extremely sensitive to interest rates. When rates are high, they earn substantial investment income and can price policies aggressively. When rates are low, investment income declines, and they must either charge higher premiums or accept lower profits. The low interest rate environment of the early 21st century created pressure on life insurers' profitability that continues to affect the industry. Property and casualty insurers also invest reserves, but for shorter periods. A fire claim might be settled within weeks or months. The insurer has less time to earn investment income. Their business model depends more on underwriting profit, charging premiums that exceed claims and expenses, than on investment income. This makes them less sensitive to interest rates but more sensitive to claim costs and to catastrophic losses. The combined ratio measures property and casualty insurer profitability. It equals losses plus expenses divided by premiums. A combined ratio below 100% indicates underwriting profit. A ratio above 100% indicates underwriting loss. The industry aims for combined ratios around 95%, leaving 5% underwriting profit plus investment income as total return. The insurance cycle is a persistent phenomenon where combined ratios fluctuate over years. During soft markets, competition is intense, premiums are low, combined ratios are high or above 100%. During hard markets, competition eases, premiums rise, combined ratios improve. The cycle reflects the delayed feedback between pricing decisions and their outcomes. Insurers might underprice coverage for years before the losses become apparent, then overcorrect by raising prices too much, creating excess profit that attracts new competition. Understanding what makes risks insurable helps explain the gaps in insurance coverage. Some risks fail the independence requirement. They affect many people simultaneously. Some fail the measurability requirement. We cannot estimate probabilities accurately. Some fail the economic requirement. The required premium would be so high that few would pay it. Some fail the moral hazard requirement. Insuring the risk would create more of the risk. This explains why you can easily purchase life insurance but cannot purchase insurance against unemployment. Mortality is relatively independent and measurable. Unemployment is correlated with economic conditions and involves substantial moral hazard. People with unemployment insurance might search less diligently for work. The private insurance market does not offer unemployment insurance. Governments provide it through social insurance programs funded by payroll taxes rather than risk-based premiums. This explains why earthquake insurance is scarce and expensive while fire insurance is common and relatively affordable. Earthquakes affect many properties simultaneously in ways that violate independence assumptions. Fires are mostly independent events. The different risk characteristics lead to different insurance availability. This explains why health insurance in the United States has required government intervention through the Affordable Care Act to function. Health risks violate several insurance principles. People know more about their health than insurers do, creating adverse selection. The costs are rising faster than general inflation in ways that make long-term pricing difficult. The industry fragmented, with insurers covering employed populations but leaving unemployed and self-employed people with poor options. The Affordable Care Act attempted to create a functioning insurance market by mandating participation, reducing adverse selection by requiring healthy people to purchase coverage, by prohibiting insurers from denying coverage based on pre-existing conditions, addressing equity concerns about people who became uninsurable due to illness, by providing subsidies to make coverage affordable. These interventions aim to create insurance markets that could not function under purely private market conditions. The results have been mixed. The uninsured rate declined significantly, but premiums have been higher than initially projected, and some insurers have withdrawn from exchange markets. The fundamental challenge remains that health insurance is not conventional insurance. It covers both predictable expenses like routine care and unpredictable expenses like major illness. True insurance should cover only unexpected losses. Covering predictable expenses makes health insurance partially prepayment for expected care rather than protection against unlikely events. Insurance makes modern life possible in ways that are easy to overlook. Mortgages require homeowners insurance, and mortgages make homeownership accessible to people who could not pay cash. Automobile insurance makes driving legal and makes drivers willing to accept the liability risks of operating dangerous machinery. Professional liability insurance makes doctors and engineers and architects willing to practice, knowing that mistakes will not destroy them financially. Workers' compensation insurance makes employers willing to hire workers despite the risk of workplace accidents. Remove insurance and economic activity would contract dramatically. People would avoid risks that might lead to financial ruin. Investment would decline because catastrophic losses could not be managed. Innovation would slow because new technologies create unknown risks that uninsured entities cannot accept. The economy depends on insurance to function, to allow risk-taking, to permit specialization and exchange, and the complex interdependencies that characterize modern economic life. The insurance industry employs millions globally, actuaries calculating risks, underwriters accepting them, agents selling coverage, claims adjusters evaluating losses, regulators overseeing companies, reinsurers spreading risks internationally. The industry manages trillions of dollars in assets, funds infrastructure and development through investments, provides economic security to billions of people who hold policies. But insurance cannot solve all problems of uncertainty. It works best for individual risks that are independent and measurable. It struggles with correlated risks that affect many people simultaneously. It cannot make the future certain. It can only make losses from uncertain events financially manageable through pooling and prepayment. Some risks must be borne individually because they cannot be pooled. Some must be borne collectively through government social insurance. Some must be prevented rather than insured against because insurance creates moral hazard. Some simply must be accepted as the price of living in an uncertain world. The mathematics is elegant and the principles are sound, but the implementation is always imperfect. Insurers make mistakes in pricing, hold inadequate reserves, fail during catastrophes. Policyholders misunderstand coverage, file fraudulent claims, game the system where possible. Regulators impose constraints that distort markets, fail to prevent failures, respond too slowly to emerging risks. The system works despite these imperfections because the alternative, bearing all risk individually, is worse for most people most of the time. The promise written in insurance policies is fundamentally a mathematical promise. We will collect small payments from many people and use the pooled funds to pay large claims for the few who suffer losses. The law of large numbers says this will work if enough people participate and if the losses are independent. History says it does work mostly with periodic failures and adaptations and continuing evolution to address new risks and new challenges. The actuaries keep calculating. The underwriters keep accepting risks. The agents keep selling policies. The claims adjusters keep paying claims. The patient arithmetic of insurance continues, making tomorrow less frightening than it would be without this patient mechanism for sharing burdens, for converting uncertain catastrophic losses into certain manageable premiums, for allowing people to face an unknowable future with enough confidence to invest and build and plan and live without paralyzing fear of financial ruin. Insurance does not eliminate uncertainty. It cannot make the future predictable. It cannot prevent losses from occurring. What it can do, what it has done for centuries, what it continues to do despite all its limitations and imperfections, is make uncertainty bearable through the simple arithmetic of pooling, through the patient collection of premiums and payment of claims, through the mathematical truth that many people sharing risk face less individual uncertainty than each would face alone. That is insurance. That is what the promise means. That is what the patient calculation across centuries has achieved. The insurance policy rests closed on the desk. The parchment has yellowed. The wax seal has cracked with age. The promise written there in 1750 was kept, or mostly kept well enough that the system survived centuries, that millions of people found protection, that the burden of loss was shared rather than borne alone. You have followed insurance across time, from Mediterranean sailors pooling risks to medieval guilds protecting members, to Lloyd's coffee house creating markets to massive companies managing trillions. The mechanisms changed. The scale expanded beyond recognition. But the fundamental insight remained constant. Uncertainty is more bearable when shared. When many contribute small amounts to protect each against catastrophic loss. This was never perfect. Companies failed. Claims were disputed. Some risks proved uninsurable. Crises tested the system and revealed its limits. But the patient arithmetic continued. The premiums collected. The claims paid. The promises mostly kept across generations. You hold policies yourself, perhaps. Automobile, home, life, health. You participate in this ancient practice of collective protection, this patient sharing of burden. You are part of the pattern that stretches back through centuries, forward through whatever future uncertainty brings. But there is no need to hold these details any longer. Let the policies fade. Let the premiums blur. Let the catastrophes and the calculations dissolve into the gentle knowledge that humans learned, slowly and imperfectly, to face tomorrow together. The mathematics will continue whether you remember it or not. The system functions without your attention. The promises written today will be kept or broken by others in time, as all promises are. Rest now. The accounting is complete. The ledger closes. Only the rhythm of centuries remains, the patient sharing of risk, the quiet promise that you need not face catastrophe alone. Let it all drift away. The ships and the fires and the earthquakes, the premiums and the claims, the patient arithmetic of shared protection. Only sleep remains, only the gentle certainty that tomorrow will come, that uncertainty is universal, that the burden is shared. Rest. The promise is kept well enough. The system holds. Sleep now.